to keep a firm hold on control in Congress?
Well, part of what Democrats are up against is simply historical precedent. I mean, if you look at the midterms for when a president first term, they just get into office, they're usually much better for the other party. And so just from a historical perspective, Republicans are supposed to do well in this upcoming midterm. But when you talk to Democrats and say, how do you guys plan to counter this? They talk about delivering for Americans. I mean, they talk about that social welfare and tax plan. They talk about doing things such as child care, elder care, expansion of health care, taxing the wealthy. I mean, this is why it is so critical right now that Democrats come to some sort of agreement on President Biden's plan and how they move forward. Because if they don't, they not only go back to voters in a year that's historically going to be much better for Republicans, thanks to redistricting and precedent, but also Republicans will be able to go back to voters and say, what did you get under Democrats? They had 2 years of complete control in Washington. They were unable to pass multiple bills. You should be giving us a chance now.
Well, and of course, Mitch McConnell, the Senate Minority Leader, wrote a letter to President Biden on Friday saying, we won't be helping Democrats again with the debt ceiling. We extended it, obviously, until December 3rd, but that's it. No more help from us. The Democrats have to figure it out on their own. What are the options on the table, assuming no Republican support whatsoever?
So right now, it seems like one of the most easiest options for Democrats would just be to go ahead and to pass it via reconciliation. They don't need Republicans. They can do it on their own. The issue with that is that for reconciliation, they can't just suspend the debt limit to a certain date in the future. They would actually have to say what they were raising the debt limit to, and you can bet that that number would be appearing in attack ads over the next year as campaigns get underway. So Democrats are looking for other options. Potentially, there's been some talk about adjusting the filibuster, that process that requires 60 votes in the Senate. Maybe if you could only do it for the debt limit with just 50 votes, just a majority of lawmakers there. That's been one thing that's been discussed. And then there are a couple sort of more out there ideas, things such as having the Treasury Secretary be the one who's responsible for raising the debt limit. There's legislation out there to do that. And of course, it seems to just be floating around the discussion of that $1 trillion coin that the U.S. Treasury could mint, although Secretary Janet Yellen said that that would be a ridiculous idea.
The success in the coming weeks, Emily Wilkins, will be mentioned by Democrats winning, Republicans winning. One of their templates, I should point out, folks, is for those of you on radio, Ms. Wilkins wears Michigan State green this morning. Michigan State killing it in the Big Ten. Let's do a Michigan State. How do the Democrats get there? What's the legislation path? What should our viewers and listeners look for in the next 6 weeks that's a victory for the Democrats?
I mean, Democrats have a lot of things to do in the next 6 weeks. They've kicked, I feel like we say this expression so much now, but they've kicked many cans down the road. Ideally for Democrats, a 6-0 looks like getting the reconciliation package agreed to and passed by October 31st. That's the deadline they've set. That means that that bipartisan infrastructure package would go as well. It means figuring out the debt ceiling well before Thanksgiving so we don't start talking again about the potential of a default. And it means passing government funding to keep the government open after December 3rd. Now, are we expecting that to happen? Not really. We've seen this story play out time and time again before in D.C. The can gets kicked to early December, then it gets kicked to late December, and then we're all here on Christmas Eve with the pressure on for lawmakers to wrap up things before they go home for Christmas.
I will not be here Christmas Eve, but thank you. Emily, you might be. I'm sorry. Emily Wilkins down in D.C. Thank you very much. Tom, the can gets kicked, and it might be getting kicked again.
Yeah, there's no question about it, John. And when you look at the can moving into 2022, you go right up against the politics. Frankly, here in, I'd suggest in other major countries as well. John, I really want to emphasize it's an odd Columbus Day. It's a Columbus Day with huge news flow.
There's a big week ahead. CPI in America, earnings season kicking off with JP Morgan. That's starting on Wednesday. Your equity market negative 1/3% on the S&P. From New York City this morning, good morning on radio, on TV. This is Bloomberg.
low point of the Greek economic debacle? What were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms. And I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
Coming off the back of the biggest weekly gain on the S&P 500 since August, we pull back a bit. We're negative 16 on the S&P. We're down 0.4%. Right now on the Nasdaq, negative about 0.6% lower. On a Russell, down by 0.4%. The US bond market is closed, but we can talk about this move in the commodity market. Switch up the board and get to crude, WTI and Brent. You've got to go back to October 2014 for the last time WTI was this high. 81 handle, 81.56 and positive 2.8%. Right now, Brent crude with an 84 handle. This contributing to the conversation around inflation. Whether it should or whether it shouldn't is a separate debate. This is what it means right now in the UK. We've heard from the chief economist, Hugh Pill. We've heard from the governor, Mr. Bailey, Governor Bailey, to be precise. We have also heard from the hawk, Mr. Saunders, an MPC official. Tom Keane, they're all talking about the same thing. The potential of doing something with rates. Switch up the board and we'll get to the yield curve in the UK. Gilts, 2s, 10s, 30s. Where do you see the bigger move? The front end, but you see move through the whole curve. Tom Keane, we're up another 5 basis points on a UK 2-year to about 60 basis points this morning.
John, the curves are dynamic, but have we seen the natural gas surge and then the pullback? Where did that fall through the weekend? Is nat gas still large in Europe as they await Russia?
Still a story, Tom, that's for sure. It's still a story. The whole power energy part of the issue is still there for all to talk about. Whether this should contribute to a central bank's next move, Tom, I think is a very separate debate, but a debate that we're having right now. And this Bank of England, let's be clear, is responding to this in a way that the Fed and the ECB, and the BOJ is not.
To our listeners and viewers, this is really important in that you see different nations apply a different approach. John, I wonder how the Bundesbank reacts as they advise Madame Lagarde on their view of this rising inflation.
If I'm a market participant right now, Tom, I'm looking around the world, I'm seeing Norway, I'm seeing South Korea, Mexico, Brazil, New Zealand, hike interest rates this year. I'm thinking about the Bank of England maybe joining them at some point over the next 6 months. The big news for most people, I think, Tom, just remains that the ECB, the Federal Reserve and the BOJ, the big three with massive balance sheet expansion supporting this market, according to many market participants, they haven't folded, they haven't buckled yet in the same way. You're not having that conversation about higher rates at the ECB like you are right now at the Bank of England, Tom.
No, you're not seeing it, and you know, this will be something to set up for the week, and again, earnings as well, part of that story on Wednesday. Right now, and we are well timed to speak to one of our great labor economists. She is inquisitive, to say the least, out of the Michigan shop. Claudia Sahm joins us, always controversial, always opinionated, and knowing that it is a day of celebration in her world, which is labor economics. Claudia, we want to stay on theme, but if I look at Guido Imbens Republicans, if I look at Joshua Angrist, and particularly if I look at David Card and Alan Kruger, I just have to say this is a day of the minimum wage. Fold their work into the observation Amazon has to give out $18 an hour to find someone today.
Right. So for these Nobel Prize winners today, congratulations. And I agree. You can go back to the really path-breaking work that David Card and Alan Kruger did in the early 1990s, and it was very careful, empirical work. Go out in the world and see what is happening in states that raise minimum wage and states that don't. Now, a lot has happened in terms of research since then, but they at least raise the question that you raise wages and you don't lose out on business. It's not bad for the company. Normally, in economics, we'd say this is going to be a problem for employers. This is going to be a problem for businesses. And they found in one case, and like I said, there's a lot of literature, there's a lot of debate after that about the effects of minimum wage, but it really opened up a conversation. Let's get past our models. Right. And let's go see what's happening.
Well, to all of this, and the incredibly acute mathematics of Angrist and Emmons as well, also working, I should point out, with Alan Kruger. Claudia Sahm, what this comes down to is the reality right now, and I have a question on local economics. Think David Blanchflower at Dartmouth. Is Amazon, Target, Costco, are they the marginal price determinant of the wage in local economies?
Well, this is a trend we have seen for decades. So this goes way beyond COVID in that you have local labor markets where there is a dominant employer. Amazon's a big company in terms of customers buying things. Amazon can be a big employer if you are in an area that has one of the warehouses. I grew up in Indiana, close to an interstate. When I go home, there's all kinds of warehouses in place now or being built. They tend to pay above the local wage, but then they have a lot of bargaining power over the workers. And that can lead to real problems, not just in terms of wages, but working conditions, right? Like we know from a lot of people that have worked in these plants or these warehouses, it's not an easy job.
And John, you wonder if this is the new form of unionization, almost the dominance of these companies setting the marginal wage.
Let's build on some of this, Tom. The contribution of Card and Kruger to the real world, the real economy for good. Claudia, a quote of yours: I want economic policy to be good, like economists to do good in the world. Larry, you're referring to Larry Summers here, is something of a I don't know. I see him as a roadblock to achieving that goal. That was in an interview with Politico magazine. Why do you think that, Claudia?
Right. Well, this really is not about Larry. It's about the change that needs to happen in economics. I think if of a generation of economists, particularly in macroeconomics, there is I have a mental model. I have a way the world should work, and I'm going to keep going back to it. Larry did an interview with Noah Smith, and he was really clear. I don't have a model. He has an intuition, and that comes from years of experience watching the economy. But the real contribution of the Nobel Prize winners today is to say, let's step back, let's go get the data, let's look at the world, and not do introspection. It is too hard and can really lead you astray if you're doing that from the ivory towers in Cambridge, Massachusetts. So that's really, and Larry just happens to be the flag bearer of the old guard. And I just, particularly in this crisis, particularly in the way that different groups of people, marginalized workers, the ones who end up working at Amazon, they need economists to be out in the world looking at the data and not sitting back and using past experience, using intuition to make decisions. So that's what that concern that I'm raising is about.
What's your advice, Claudia, then to A, students of economics right now who are just starting out, and B, much bigger question, I think, for policymakers at the Federal Reserve who have been conditioned by everything you just said?
Mm-hmm. Yeah, so economics is all around us, right? It's not just listening to what the Fed's going to do, what the markets are doing. A really big debate that's happening right now that is absolutely using the tools of the prize winners today are the debates about what is causing the labor shortage. How important was unemployment insurance in that holding back of workers, there's a lot of debate on Friday about not seeing big numbers now that in early September, those benefits expired. And they're absolutely using those methods because we saw different states roll off their benefits at different points this summer. So these tools, they've been refined since they've been developed, but economists are out there trying to answer the questions about people, about labor markets, that policymakers need to know so that they can make big decisions.
Well, let's talk about the questions in the labor market. Participation has remained stubbornly low. We saw more evidence of that on Friday. Is that, again, transitory as we talk about so many of the shortages out there are, or is that something structural?
Well, I've said throughout this, COVID is the enemy of everything that is happening in our world, and it is absolutely the case in labor markets. Now, it's not the only factor. I think in the labor markets, and we actually see this a lot of places, whatever problems we were living with before COVID, those became so much worse, right? If you think about before COVID, there were a lot of parents that struggled to get childcare. It was often extremely unaffordable in areas of the country, like where I live outside of Washington, D.C. And then we have COVID, and it becomes harder, it's less reliable. A lot of parents are concerned about it not being safe. And so that decision that was always hard, do you have like the one wage earner, often the mother who would make less wages, do you have her stay at home or does she go back to work? Right? Like that got so much worse. And we saw a lot of parents drop out of the labor force early on. And one of the disappointments on Friday was it's fall, schools are reopening. Mm-hmm. It's a little rocky because kids get sent home if a COVID exposure. Women didn't come back last month. September was supposed to be one of the big ones. So that's just one example.
Claudia, is what you're saying helping make the case for some of the social policies on the table in terms of longer-term economic spending in Congress? Childcare is included in that.
Right. So I think we're at the point now where we have seen this in so many places, the structural problems, the labor market in general. Low-wage workers had a lot of problems in terms of what they were able to bargain for before. So let's fix those. This crisis has amplified and made it so obvious that the inequalities, the inequities in our economy they're holding us all back. Now, Congress has not done big future-looking, long-term investments in the country for a long time. And frankly, it is absolutely frustrating to see the whole debate about how many $1 trillion. We have a lot to do in this country. And sadly, I think Congress doesn't have a lot of practice recently at getting it done.
Claudia, we've got to leave it there. We appreciate your time this morning. We really do. Thank you very much for being with us. Claudia Sam there of the Jane Family Institute and a whole wealth of experience, Tom, back at the Federal Reserve as well. I want to bring up Southwest just quickly in the pre-market. This company, this airline in America had to cancel 27% of its flights in the last 24 hours. It's negative 1.8%. And Tom, there is a separate conversation, but I wonder whether it's related. Pilots at Southwest pushing back against the vaccine mandate.
This needs to be reported out. It is sketchy at 6:41 a.m. New York time, John, but is this a vaccine protest?
We do not know.
We do not know.
52.95 on Southwest. Coming up, Joshua Sharfstein of Johns Hopkins Bloomberg School of Public Health, the Vice Dean, joins us next from New York. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The price of oil went over $81 a barrel today. West Texas Intermediate futures rose 2.7% to the highest level in 7 years. It is up about 30% since mid-August. The global power crunch is boosting demand for oil ahead of winter. In the U.S., Merck is seeking emergency use authorization for a pill to treat the coronavirus. That brings the drug molnupiravir closer to becoming the first oral antiviral treatment for the disease. A study found it cut the risk of hospitalization by about half. Merck makes the pill with its partner Ridgeback Biotherapeutics. 3 academics at U.S. institutions have won the Nobel Prize for Economics. David Card, Joshua Antigrist, and Guido Imbens were honored for their work analyzing labor markets and natural experiments. The Royal Swedish Academy of Scientists says the 3 demonstrated that many of society's big questions can be answered. The UK is headed for a fight with the European Union this week over border controls in Northern Ireland. UK Brexit Minister David Frost will ask for a significant change in the Northern Ireland Protocol that governs post-Brexit trade flows with Ireland. The EU has said it won't renegotiate the agreement, but it's willing to make adjustments to ease the bottlenecks. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
FDA has a very busy week or two coming up right now with vaccinations for 5 to 11-year-olds, boosters for various other age groups. And so it's going to be really an interesting couple of weeks to really tell what the rest of the fall and early winter is going to be like in terms of our COVID-19 vaccination campaign.
Dr. Andy Pekosh there of Johns Hopkins, professor and virologist. From New York City this morning, good morning. Tom Keene, Jonathan Ferro, Katie Lyons, Lisa back with us tomorrow. Your equity market down 23 on the S&P. We're negative 0.5%. Outside of that, yields are higher in Germany by 4 basis points to negative 11 basis points. We start to have that conversation about the road back to zero. The US bond market, of course, closed today. In the FX market, euro dollar 115.65, and it keeps getting your attention, up by almost 3% now. 81.66 on WTI, 81.65. Tom Keene, the highest since the back end of 2014.
Oil front and center. I'll have to see what a gallon of gas does. Again, the metric I use is AAA unleaded, and John set it a rather low 318, then 320, then 322. I would calculate about 358 a gallon is maybe where the pain sets in. On the COVID, on the vaccine, I don't know where I sit, things are getting better, but where I sit maybe isn't the rest of America or the rest of the world. It is a world of vaccine protest, whether in Rome this weekend and thousands, Melbourne, Australia again, and others around the world, and the oddity in America of possible vaccine protests by businesses and by their employees. Joshua Sharfstein joins him, Johns Hopkins Bloomberg School of Public Health. Joshua, are you surprised by vaccine protest?
I'm not surprised, given just how polarized the whole pandemic has been over the last year and a half. But I think we have to realize that when there are a lot of cases, people see the problem right in front of them, and they're more likely to go get vaccinated. When there are not a lot of cases, people wonder, well, do I need to get vaccinated? And then there's so much misinformation out there that keeps them from getting vaccinated. So as we look to the future, and the good news that it looks like we're on the right side of the Delta wave, it's coming down. Things look a little bit more optimistic going into the fall and winter. But also, it may be that people will feel less likely to be vaccinated because of that. So I think we're going to be seeing this, and it might be industry by industry, particularly for industries where workers might leave.
The general counsel or the chief medical officer of a given Fortune 500 company dials 1-800-SHARFSTEIN and says, what should we do? How should business respond to vaccine protest?
Yeah, I've been on the phone with some businesses like that, some organizations, and it's really important to focus on countering misinformation. There is so much misinformation. I've done some, big kind of town halls with employees, and the questions come from truly out of left field, with sometimes just almost no basis in reality whatsoever. And, I think one of the insights I've learned from some experts in misinformation is that people like me, we tend to think we explain it once, people should understand. Meanwhile, the misinformation is coming at people morning, noon, and night. So it's really important for employers to constantly be communicating different ways, different messengers, people that their employees can relate to, and be relentless, because the misinformation is relentless.
Well, this is no longer just about adults, Dr. Sharfstein. Obviously, we're awaiting an FDA decision on the vaccine for children that could come later this month. CBS and YouGov put out a poll over the weekend that even among vaccinated parents, only 61% of them are willing to have their children get a shot. Do you understand that hesitation?
I think that it is a little premature to be making too much of those polls, because we really haven't had a full airing of the data, full discussion with the advisory committee. All we really have is a claim by the company at this point. So I think parents are right to be saying, okay, let's take it one step at a time. Now, just like with the adult vaccine, I think there'll be some people who jump out and want to vaccinate their kids early, and others may be a little bit more in the wait and see camp. It's going to be really important for the FDA and CDC, not just to make a decision based on the evidence that they have now, but to explain how they're going to get more evidence, how they're going to be able to share that evidence so that people can see what's happening and ideally build confidence with more and more people over time.
Is herd immunity still an achievable goal?
Well, to the extent that herd immunity means there's not going to be a lot of COVID around, I think we're going to hopefully get there unless there's a big, mutation in the virus. But herd immunity doesn't mean no virus, and it doesn't mean no risk, and it doesn't mean there couldn't be outbreaks here and there, particularly where there are pockets of people who are unvaccinated. So I think, the more likely scenario is that we will be living with the virus, and hopefully we'll be living with a low level of the virus rather than a medium level of the virus.
Tom, have you noticed that the messaging has changed on TV? The commercials are less about get a vaccine and much more about mental health. Did you notice that in the last week or so? I can't think of a single vaccine commercial that I've seen from New York State over the past week or so on TV.
I think there are subtle shifts here. Part of it is the impatience of people, and part of it is legitimate protest. I mean, what's fascinating to me is how will this amend when finally we get 5-year-olds to 11-year-olds? John, I have to admit, a 7-year-old descended on the house this weekend.
Yeah.
It was an odd and beautiful thing. We tried to trade the 2 dogs for the 7-year-old, but that didn't work out.
I imagine that didn't work out.
And, to be honest, John, as an idiot, I was confronted with what others like Ms. Abramowitz face each and every day.
Let me get to the doctor on this.
They got a kid in the house unvaccinated.
Doctor, have you noticed that? Am I noticing something or nothing at all? I see a lot more now about mental health than I do about get a vaccine.
I have not particularly noticed that, but I'm not maybe watching TV in New York. I would say, though, mental health is extremely important. And, this pandemic has affected people in so many different ways and it's been so difficult in so many different ways. It's really important to pay attention to that, too. But, a vaccine is a path to fewer cases, which hopefully will, help everyone's mental health.
Doctor, thank you. Dr. Joshua Sharfstein there of Johns Hopkins, the Bloomberg School of Public Health Vice Dean. Tom Keene, that's a change. And let's be clear, mental health has been a massive issue in the last 18 months. But the priority, the absolute priority, has been to really make sure that we stayed at home, Tom. We stopped socializing in the same way. That was the start of all of this. And, Tom, there's been a real change.
There has been a real change. And it's something, again, John, we ebb into the autumn. It's just gotten colder in New York, folks, and we're starting to think about a different month, I should say, for this virus. Again, John, I'm looking at the child vaccine. John, as we have a Nobel Prize today, we also have a changing of the guard in private equity, in entrepreneurship, in investment America. Going back to 1976, George Roberts, a guy named Kravitz, and Jerome Kohlberg started a firm called KKR.
One of the K's and one of the R's, Tom, stepping down and handing the reins to Joe Bay and Scott Nuttall. We'll build on that in just a moment.
Yes.
From New York City this morning, good morning. Tom Keene, Jonathan Ferro, together this morning with Katie Lyons. Lisa back with us tomorrow. Equity futures down 23. We're negative 0.5%. From New York City, the bond market in America is closed. In Germany, it is open. Yields are higher.
Why are we here?
By 4 basis points to negative 11 basis points on the day. From New York City, this is Bloomberg.
something wrong with her eye. And when I had a look, it looked like she was blind. The vet that she's registered with were only doing telephone appointments, which was a bit pointless because she really needed to be seen by someone. And I couldn't get one anyway for like another week. I was just quite worried about, you know, the complications of leaving it for so long.
we've seen millions more animals becoming pets in the past year due to the people having increased time at home. What we're also finding is due to Brexit that we're having decreased numbers of European vets working over here. So unfortunately, we're unable to meet that current demand for pet services. Also, COVID's got the inevitable impact with people having to self-isolate.
It is very limited what we can diagnose, so it's more about peace of mind and determining whether they do need to be seen in person.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You look
drop
great.
the bow tie. Drop the bow tie.
What,
Drop
skinny
the bow
tie?
Yeah. I always say, this is my line, whenever anyone in America has to go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
We're starting to get some signs that we're getting back to one labor market, but it's still not back to the way it was pre-pandemic.
I don't think it will derail the Fed. I think wage growth is actually as important as the payroll report.
In a stagflationary environment, they're going to tolerate that higher degree of inflation.
Tapering is in train. And so, I think Chair Powell already set up for a possible disappointment.
It's all about the hikes. I think the market now has essentially priced in the start.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Big week ahead from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene. I'm Jonathan Farrow. Together with Katie Lyons this morning, your equity market down 23. We're negative 0.5%. Earnings season, Tom Keene, begins unofficially this week.
Yeah, I really agree with you, John. We spent the last hour in celebration of the Nobel Prize. We'll do more on that. Far more important, John, this week is a crowded calendar, the inflation data, and I agree with you, the mystery of this earnings season.
No mystery in the performance of bank stocks so far this year. Year to date, Tom, up almost 40% on the KBW Banks Index, a rally of 35-36% over in Europe for the same industry.
Grinding like Brent, let's grind with the vanilla spread. The difference in yield between the 10-year and the 2-year, it was 120 basis points, move the decimal over 2 bases. It's now 129 basis points. It's a little bit of curve steepening.
Have you got a word on energy, Tom? 81 handle on WTI, 84 on Brent.
I always believe, John, that the fancy suits and ties and bow ties underestimate when this kicks in. I was in L.A., John, doing a speech or something years ago. It happened to be in a bar. And I looked out the window, and the gasoline across the street said $4 a gallon. And that really woke me up. And granted, the national price is lower than that. How soon are we going to get there?
For anyone just tuning in, perhaps you're new to this program, every story Tom tells has a bar in there somewhere. Katie, I'm looking at Southwest this morning. We're negative 1.7%. That airline, some real news there in the past 24 hours.
Yeah, it had to cancel more than a quarter of its flights yesterday on Sunday, John. They technically blamed weather and traffic control issues, but of course Southwest is also dealing with a bit of a revolution when it comes to its pilots, a group of them protesting the vaccine mandate that the airline has put into place. So it raises the question, how much of this may be about that? Again, that has not been reported. The airline said that it was air traffic control, weather problems, but you didn't see the other airlines having to cancel the same number of flights yesterday. So it raises some major question marks.
That's the issue, isn't it, here, TK? Katie's right. 28%, 27% at Southwest. Let's call it a third. I did not see that at Delta. Didn't see it at United. Didn't see it at American in the same way.
This has to be reported out. I read 6 or 7 articles. It's such an odd story and underreported, John. We need to be very careful, folks. We're always trying to be fact-based here. The New York Times has a treatment that goes first, John, to what you said. Wait a minute. They were down because of weather, because of government air traffic controllers out. Why wasn't Delta impacted? Why wasn't American Airlines impacted? But it's much more lit up like a candle in social media, is a protest of people who in some form or another are anti-vaccine, supporting the labor of Southwest Air. I don't know which it is.
Southwest clearly impacted. The stock is negative, about 2 percentage points right now. That's a single name for you. Here's the broader market. Your equity market is softer, negative, lighter, lower, down 0.5% on the S&P. We're down 21 points. Outside of the equity market, I'll get to the bond market, Tom. We're closed for Columbus Day in America. But Germany's open. Bund yields are higher by 3 basis points to negative 11. You can take a look at the UK as well. In the United Kingdom, we're having a bigger and bigger conversation about hiking interest rates. The 2-year over there, Tom, 5 basis points, approaching 60 on the session.
Yeah, it's there. And now you're looking at the Swiss 20-year right now. It's a big 0.14%. Yeah, it may not sound like a lot of yield, but that's ginormous over where it was, John, 90 days ago.
Bit of news out of KKR as well. We'll get to that in just a moment. Let's get you through the day ahead. Kaylee, a ton coming up today and through this week.
Yeah, a ton coming up in Washington, D.C. in particular, where the IMF and World Bank meetings start today. It's going to be less about the meetings and more about what the fate is of the managing director, Kristalina Georgieva, given the ethics probe into her role at the World Bank and the action she may have taken to change the ranking of China. We understand a decision could come as early as today. So that will really be the undercurrent of those meetings, less so whatever they say about the global economy and those forecasts. Also happening in terms of meeting today, kicking off the annual Institute of International Finance as a virtual event. We'll hear from the likes of JP Morgan. So interesting to hear the commentary around the banking environment, especially given we get all of those big bank earnings over the course of the week, beginning on Wednesday with JP Morgan. Now that will run through Friday the 15th. And finally at 6 p.m. Eastern time, we're going to get some Fed speak. Chicago Fed President Charles Evans will be speaking at an event. The question is, what does 194,000 print on non-farm payrolls for the month of September mean to the Fed? Is that still substantial further progress? And is a November taper still the most likely scenario, John?
We needed a, quote, reasonably good report, and Kelly Lyons, a lot of people think that was it. The light is still green for tapering of the Federal Reserve. November 3rd, that next meeting. On private equity, Tom, we saw it at Carlyle, we saw it at TPG, we saw it at Apollo, and now we're seeing it at KKR. It's a changing of the guard. Henry Kravis, 77, his cousin George Roberts, 78. 2 of the 3 founders of this company stepping aside, Tom, and opening the door for new leadership.
I'll not mince words. They've been very quiet supporters of what we've done here, John, at Surveillance over the years. They don't like, Henry doesn't like to get up early in the morning. He just, he's like, I'm not.
Doesn't like 6 or 5 a.m.
Roberts is even worse, but the bottom line is these are 2 giants. And John, it's not what they did, it's the when of KKR. We have forgotten that. Long ago and far away, it was original.
And the likely successors are the successors, Tom. Scott Nuttall and Joe Bay taking over. So we've had a change of the guard, Tom, at KKR, at TPG, at Apollo, at Carlyle. There's one left, isn't there?
Yeah. Well,
Mr. Schwarzman.
Yeah, I mean, it's a generational thing. And, John, we're seeing this. I mean, you can talk about the entertainment of, succession and the rest of it. But the bottom line is time is marching on. And a lot of good people are trying to get out and control it. I give KKR great credit for doing this over a number of years sequence. Carlyle, frankly, the same way.
There's a big effort taking place here at Bloomberg to put a lot of this story together. So look out for some of that on Bloomberg.com and on the Bloomberg terminal. We need to talk about this market. We can do that with Mark Howard, BNP Paribas Senior Multi-Asset Specialist. Mark, we're having a bigger and bigger conversation about the end of easy money. New Zealand, South Korea, Mexico, Brazil, take your pick. Right now we're talking about UK joining the likes of Norway. Mark, can you walk me through the end of easy money? Is this the beginning of the end, and what does it mean for you?
Well, thanks, John, and good morning, everyone. Yeah, it is. We're moving in that direction, and I think it's a really important narrative, as your montage just showed. We don't think the number for payrolls is going to change the U.S. taper story. We think the U.K. call is a tight one. But, central banks want to take some of the largesse back. And it's complicated, heavily complicated by what you were talking about earlier in the energy and power markets. That is a really important narrative that I urge investors not to be complacent about because it greatly complicates their task.
Tell me about BNP Paribas' thoughts on gradual. The hope of the bulls is all of this is identified, gradual, and that the reaction functions forward will be smooth and controllable. Do you buy it?
I do, Tom, and I don't think there is a proverbial gun at their head after they're done with tapering to necessarily hike immediately or quickly. In fact, I think the minutes this week may actually show that there's some hearty debate about that, and that they are going to be gradual. They're going to be consistent, removing the tapering, but then the hikes, which we think will start in the fourth quarter of next year, they need not be immediate and rapid. They can calibrate that based on the economic conditions at the time.
Well, obviously, what central banks are weighing is the inflation equation, and the equity market has been weighing that as well. You have the likes of Goldman Sachs and JP Morgan saying the inflationary or stagflationary fears present now will abate and the rally will continue. So buy the dip is the call. How long can buy the dip continue to work?
Kayla, it's a very vexing issue that a lot of our big institutional investors are asking right now. And I think my own personal view, and I think our house view as well, is that one needs to be patient about buying the dip here in Q4 for a couple of reasons. It's not just about higher rates and higher inflation. It's the earnings impact of all these kind of post-COVID dynamics, whether it's higher energy because there just isn't capacity coming on stream anytime soon for carbon, or whether it's power challenges as a result of both higher inputs and other systemic issues. We saw in Lebanon over the weekend, for example. We saw in Texas last year. As we get into the colder months in the north, these power issues are going to be a bite. They're going to be a tax on consumers, both gasoline, as Tom was talking about, but also heating and other activities.
So, Mark, before you go, what is the conviction trade for you, sir, into year end?
Into year end, I think it's being nimble, being very careful about buying the dip, being thoughtful, particularly around earnings, not so much this week with financials, but next week when we get a lot more texture from companies who are going to have to give forward outlooks. And we think earnings expectations are going to come down. So we would be patient about buying the dip in risk assets. The other conviction trade, Tom, is around energy versus on energy. For example, we like U.S. high yield versus European high yield because there are different energy components there. Or, for example, Russia and Colombia versus India and China in the emerging markets.
Ruble absolutely flying recently, Mark, as well. Really picking up in a big way. Mark, we've got to run. We've got to leave it there, sir. Thank you. Mark Howard, BNP Paribas Senior Multi-Asset Specialist. Tom, we come back to a question we've been asking a million times, it seems, over the last month. Will those higher prices hurt the ability of central banks to remain easy, to support this economy and ultimately support this market?
Yeah, we're doing a lot of economics today, the Nobel Prize and certainly the inflation data coming up, John. I'm going to ask the same question you asked, John, to what do these higher prices mean for corporations? And that's a great bull-bear call here. The bulls are saying they'll adapt, they'll figure it out. Maybe it's some revenue raise, maybe it's different expense structures that they need to work with, and the bears are saying the world's going to come to an end.
The focus on margins coming up in the next hour.
Agree.
The focus on higher rates. A man who thinks we need them, that higher rates are a good thing. It's Drew Mattis of MetLife Investment Management, the chief market strategist. He joins us in the next hour from New York City. A weight to the tape today. We are down 0.5% on the S&P. We're negative 20 points. From New York City on radio, on TV. Good morning to you all. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The billionaire founders of KKR are giving up their leadership roles. Henry Kravis and George Roberts are stepping down after dominating private equity for almost half a century. They have elevated Joe Bay and Scott Nuttall to co-chief executive officers. The U.S. has arrested a Navy Department employee and his wife for allegedly selling secrets on nuclear-powered submarines. According to the Justice Department, the buyer was an FBI agent posing as a foreign official. Authorities say the case involved cryptocurrency payments and a memory card hidden inside a peanut butter sandwich. Hong Kong's chief executive is defending coronavirus travel restrictions that are frustrating global businesses. In an interview with Bloomberg TV, Carrie Lam signaled the curbs will stay in place for the foreseeable future.
Of course, I am concerned, and we are working very hard to resume normal travel in a gradual and orderly manner, both with the mainland of China and with overseas places.
Lam says that mainland Chinese officials want Hong Kong to follow their own strict approach to wiping out the virus. The International Monetary Fund's Executive Board will deliberate today over the fate of its chief, Kristalina Georgieva. Directors have spoken with her and the law firm that alleged improper actions in her previous job at the World Bank. Georgieva has denied any wrongdoing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Natanggap ko po ang inyong nominasyon sa akin bilang kandidato sa pagkapangulo ng Republika ng Pilipinas. I am a fighter, and I will always be a fighter inside and outside the ring.
How far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet
We might be.
that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
How is Ireland dealing with that blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours, and renewables. We have a very strong climate component in our government and in our government programme, and that of course is not disconnected from the energy agenda. And there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
It's about the pandemic, and this is not just an American issue. This is a worldwide issue with participants rate in the workforce. We clearly have more work to do. People are concerned about the Delta variant. People are concerned about their health, and I think, quite honestly, a lot of people are reevaluating their work-life balance and changing careers.
Marty Walsh there, the US Secretary of Labour. We have a shortage in this country. We don't have a demand problem. We have a supply issue, and we saw that captured in the labour market this past Friday. With Tom Keene and Jonathan Ferro alongside this morning, Katie Lyons, Lisa back with us tomorrow. Your equity market is negative 16. We're down 0.4% on the S&P. Into the bond market with the US bond market closed. Tom, it clicks. That's why Lisa's not here. The bond market's closed. Does that make sense now?
Yeah,
I didn't realise. I didn't know. Okay. Bond market is open. Yields are higher by 3 basis points to negative 11 on German 10s. We approach zero again. Euro dollar 115.67 unchanged. And there's the move. Up by 3.5%. We add $2.75 to the price of WTI crude. Tom Keene, we have an 82 handle, 82.10.
Yeah, I'm going to go to the German statistic there, John, and I think it's very important as a global proxy and for the U.S. as well. I mean, you add 2 here, you get out to a 1.63 if you add 2 to the U.S. yield right now closed. And, again, you're just grinding up. I mean, imagine, John, going through that 170 level of months ago.
170 is just around the corner, Tom. Yeah. 161 was the close on Friday. We're not far.
Round it up.
What's that, a day?
$85 a barrel on Brent.
Have a look at what the banks have done, Tom, just quickly. Off the back of that September 22nd meeting at the Federal Reserve. Up more than 10% on JP Morgan. I think we're up 13% on Bank of America. Just a quick change like that, a conversation about the future and the potential for higher rates. And there we are. The bank's off to the races again.
We'll dive into that, starting with our earnings season. Right now, we go to 1600 Pennsylvania Avenue. Justin Sink, our Bloomberg White House correspondent. How beleaguered is this president, Justin? I can't figure out for the media, those that are fair and balanced, those that maybe have a certain angle this way or that. How beleaguered is this Monday morning, this Columbus Day, for President Biden?
Well, he obviously doesn't have the momentum that he had hoped going into this week and going into the next few weeks. Basically, he was able to convince Congress to punt all of his problems till December, which both doesn't help him in the short term when he is about to head in a couple weeks internationally, doesn't have in hand some of the deals that he wanted to be able to show off, and because he hasn't actually solved any of these problems. So it's not as bad as if he had gotten final no's on this reconciliation deal, if the infrastructure deal had completely fallen through, if we had hit the debt ceiling, but it's certainly not kind of a position of power.
What does he say to Bernie Sanders? What does he say to the arch liberal of the Senate?
Well, I think, as much as Bernie Sanders has been voicing anger and frustration with the moderates like Kristen Sinema and Joe Manchin, Bernie also, I think, understands that this is his one chance to get big social programs through. So the tougher thing is going to be getting those moderates versus selling Bernie Sanders on a deal that's smaller than he wants or smaller than he advocates for. I think we've seen time and again that Sanders is willing to go along with the sort of half a loaf if that's all that is there on the table.
Justin, that's on kind of the socially oriented spending side. When it comes to the actual infrastructure package, $550 billion of bipartisan spending, if that fails, does President Biden have to completely abandon his promise to govern in a bipartisan manner? Is there any other opportunity for that?
Yeah, I mean, the problem is that he is even struggling to keep the Democrats on board, right? The infrastructure package, the reason that it hasn't gone through isn't that the votes don't exist or the support doesn't exist. It's that those progressives and those moderates are using it as sort of leverage in this broader fight. So if the whole thing falls apart, he's going to really start facing questions about whether his presidency is a failure, because this is his sort of one window to get things accomplished and get things done. And I think everybody at the White House is acutely aware of that. It's going to prompt sort of a reset if it's entire presidency and strategy if he's not able to convert these in the next couple months.
That's on the domestic side, Justin. What is his biggest foreign policy headache at the moment?
Well, I think that they're in some ways interwoven. So he's got this big climate summit coming up in Glasgow at the beginning of November. And to be credible there, the U.S. is going to have to bring climate financing to the table. We're going to have to bring a sort of credible way for us to reduce greenhouse gas emissions here in the U.S. And for the president to do that, he's going to need that reconciliation package. Foreign leaders are very tired, I think, of making commitments of their own based on the U.S. and then just seeing a new administration come into power or a Democratic president not be able to deliver on some of the climate promises that he's made. So, as the president heads into that G20 summit in Rome and then the climate summit in Glasgow, if he's not able to deliver on his domestic agenda, it's going to impact some of those foreign conversations.
Justin, one of the Republican talking points at the moment are higher prices. You're familiar with this conversation. I just wonder how nervous this administration are getting with crude at $82 a barrel on WTI when you hear the energy secretary start to talk about releasing oil barrels from strategic reserves. Justin, do you sense an increased nervousness in the last several weeks?
Yeah, so I think that there's two questions there, right? On the energy sector specifically, we know that they've stepped up their conversations with OPEC. We know that they are at least not ruling any of those things out. Yet what we haven't heard yet is those proactive steps. And so I think there is a little bit of wait and see going on right now. And this again ties back into that climate conversation where there's some certainly within the White House that see a strategic advantage in there being high traditional energy prices because it helps push that sort of green revolution. So all of that's in play on the energy sector. There's also, I think, increasing concern about those supply chain hiccups that both are driving up prices, but also throwing a lot of doubt into how successful the Christmas season is going to be if people aren't able to buy gifts, if there are still supply chain problems, if we're still having lagging employment. All of that paints like a really negative picture for the president.
Justin, thank you, sir. Justin Sink, our Bloomberg White House correspondent down in D.C. Tom, many of these issues playing out right now are, of course, not tied back to this administration. They predate this administration. They're not anybody's fault. We're talking about reopening an economy and some of the supply chain issues that come off the back of that. There is one thing that sticks out, though, and that's whether we should have juiced demand the way we did. There were people who asked that question at the time we passed the most recent big bill at the start of this year, Tom. When you look at crude at 82, Brent at 84, it's pretty clear that people will be looking for someone to blame going into next year if prices stay like this.
Yeah, John, I'm glad you bring this up because I've mentioned this, and maybe I'm wrong on this, but I think you're right that it is a hugely emotional feature that fancy people on the right and the left coast don't understand. There's a trip point, and I don't know where that is, John, on a gallon of gas. I don't know where that is on Brent or West Texas Intermediate. But there is a tradition, people get very upset.
Brent crude up $2 this morning to $84.50. WTI just south of 82 now, up by $2.60, up by 3.3%. Coming up, Jeremy Stretch, the CIBC head of G10 FX strategy. Strong dollar has been a story over the last month. We'll build on that for you. From New York City this morning, good morning on radio, on TV. This is Bloomberg.
China's growth because it is already slowing. Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, port delays, chip shortages, saddled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Earnings season just around the corner in New York City this morning. Good morning. Equity futures negative 15. We're down around about 1/3%. On the Nasdaq, we're down by 0.6%. On the Russell, softer, lighter, lower, -6, down 1/3%. Earnings season around the corner. That starts Wednesday, unofficially with JP Morgan numbers, and we get CPI data in the United States of America as well on the 13th. This is the story for the bond market this morning. Treasuries closed for Columbus Day, so you look to bunds, you look to gilts. Right now, yields higher by 3 basis points on a 10-year bund, approaching zero again. -11, call it -12 basis points. The biggest shift we've seen more recently has been in the UK. There is a bigger conversation now about hiking interest rates. We've heard it from the chief economist, Hugh Pill. We've heard it from the governor, Mr. Bailey. We hear it from the hawk, of course we do, from Mr. Saunders. Yields higher over in the UK by 4 basis points to 1.2% on 10s, and much more so through the curve. On 2s, we've had a real move on 2s. So why? Well, we're talking about what? Higher prices, energy rallying, 80 through 80 on WTI. Had a look at 84 on Brent a little bit earlier. Higher prices, upside risk to prices, and downside risk to growth. What does that mean for profits? Here's a story for you. Let's switch at the board and finish on this. It's a chart from Citi. Our team here at Bloomberg put this one together in a piece over the weekend. I thought it was a really important piece as well, Tom. What it does is get together global profit expectations, upgrades versus downgrades. Upgrades minus downgrades. And what do you end up with? We roll over pretty aggressively over the last 2 or 3 months. And Tom, that just really capturing the story we've been discussing on this program now for months. That is, growth expectations are heading the wrong way and inflation expectations are heading the other way. That's not a pretty picture for risk assets.
And the rationalization here is inflation won't affect anyone as well. John, how about $7.44 a gallon? That's if you do the liter conversion and all that.
We did that last week, Tom.
We did that.
£1.35 a litre times 3.8 to get to a gallon.
Yeah.
Gets you to about £5 a gallon. Put the foreign exchange layer on top of that.
Very good.
Multiply it by 135, 136. It's something north of $7 a gallon.
You can only do that, folks, if you're full Brit. We in America can't do that.
Well, I thought I was full Yank. Am I full Brit or full Yank this morning?
No, you're always full Brit. There are times where you're full Yank.
Thank you, Tom. Equity futures down about 1/3%. That's the cross-asset price action for you, just to set you up going into Wednesday when earnings season starts. And this week begins. Let's get you some movers this morning and say good morning to Romain. Morning, Romain.
Hey, good morning, John. Let's stay on the energy theme. Of course, crude oil here in the U.S. firmly above 80. Brent crude also above 80 here. I don't know what that translates into in pounds, but with regards to the pre-market action here, you are seeing quite a few of the big names here in the energy space higher. Marathon, Devon Energy, basically everything in the shale patch getting a bid here. A lot of speculation now here that the $80 price point might actually actually be the tipping point for a lot of these companies to start ramping up production. Keep an eye on KKR shares slightly higher here. There, a changing of the guard. This was well telegraphed here, of course, with the two leaders here stepping down, basically stepping aside to be co-chairman, two new co-CEOs being put in place. And Southwest Airlines shares down about 2.6% here right now on all those outages that occurred over Sunday here, more than 1,000 cancellations, 500 delays. Southwest says this was all because of weather and a few other issues. Well, the FAA says not quite. Those weather issues that actually related to some issues that happened on Friday, they had no evidence that that's what affected these flights on Sunday. They said what affected the flights on Sunday was an inaccountability of aircraft and staffing. The pilots union, we contacted them. They said that there were no planned issues with their pilots or unplanned issues either. There's a lot of speculation online about what really happened. I'll leave that speculation to the interwebs, but you are seeing some downward pressure here right now on the shares. Flip up the board here, an upgrade here for SoFi, the fintech company, Morgan Stanley. Bessie Greatsek over at Morgan Stanley, initiating coverage, I should say, with an overweight and a $25 price target. Starbucks hitting an upgrade over at Deutsche Bank to buy, and Robinhood down about 1% here after an amended filing on Friday that's going to basically allow some of its insiders to sell their shares sooner than planned. That's going to take effect on Wednesday of this week. Also in that filing, they had some interesting commentary about some of the regulatory pressures with regards to crypto and payment for order flow. That's putting downward pressure on the shares, Tom.
Ryan Bostic, thank you so much. Right now in the deepest mark is the litmus paper that will get us through Q4 and into next year. Jeremy Stretch joins with CIBC, head of G10 foreign exchange strategy. Given inflation, Jeremy, whether transitory or not, what would you presume the dollar will do?
Good morning, Tom. Well, I think in the current environment, we continue to favor the dollar continuing to appreciate. We continue to anticipate that it will perform strongly against those funding currencies. So that continues to see the euro under pressure. That continues to see the yen maintaining that significant uptrend that we've been seeing over the course of the last few sessions in terms of dollar yen. And also we would prefer to be looking at dollar Swiss higher as well. So I think the dollar should remain relatively well supported. There is that liquidity element. And I think also in the context of the central bank dynamics, we are, of course, getting somewhat closer to that tapering narrative in the US. And those other funding currencies are still some considerable distance away from that, because ultimately things like the or central banks like the ECB are going to be probably on hold for the next two to 3 years. So I think that still favors long dollar positions.
Jeremy Stretch, Jan Hansi is scheduled to join us from Goldman Sachs here in a bit. You have the huge advantage of Benny Tall Economics up in Toronto. Benny owns the analysis of small business, what we see in the dynamics of the American labor economy. How do you overlay that onto your foreign exchange calls?
Well, it's absolutely right. We do need to understand how the labour market and labour market dynamics are going to play out. Now, of course, we are in the backwash of last week's labour market data, but I think we're still of the opinion that we will see a gradual movement towards the labour market improving, and I don't think that narrative has materially changed. So we're still relatively constructive in terms of the broader macro dynamics in the US. You're absolutely right, though, as John was just highlighting, that we have seen a substantial repricing of both growth and inflation, not just in the US, but globally. But I don't think that necessarily is going to be a defining factor in terms of changing the broader trend towards US dollar gains.
Jeremy, I'm hearing more and more from multi-asset strategists about hedging now. With the bond market and risk assets, equity markets, let's take the S&P this morning as an example, heading in the same direction. Bonds down, equities down, and thinking more about how I can hedge that kind of story through FX, where I can find a little bit of safety. Jeremy, you're having a bigger conversation about that with clients more recently.
You're absolutely right. I think what we are seeing is that yield levels are moving up, so prices falling lower. And I think that is causing consternation regarding the asset markets, in particular in terms of the equity space. And so I think that does leave investors increasingly looking for a degree of safety and security. And I think that in that context, from the FX perspective, does lead us back towards that broader dollar narrative. But clearly, we are in a scenario where the liquidity support mechanism is no longer quite so beneficial for the broader equity dynamics, and we are seeing those equity markets under pressure as yields continue to climb. And of course, that is very much a function of the energy price spike that we're all living through as we speak.
Do I find my FX safety in the likes of the yen, the Swissy, or do I need to buy the ruble? Jeremy, which one?
I wouldn't necessarily be heading directly towards the ruble per se. You're absolutely right that, of course, the yen and the Swissy are often perceived to be the usual barometers of safety. And in a sense, we have seen that reflected in terms of moves in Euro Swiss of late. But I think there is still some question marks about that sort of yen story, because we are still very much in an environment where Japanese investors, I think, are exporting capital in order to facilitate and find higher yields. We saw that in the MOF flow data last week. So I think if we do see a significant and substantive rally in dollar yen, then there may well be some opportunities to start to fade that rally. But overall, I wouldn't necessarily be rushing headlong towards the yen and Swissy just yet. And I think the dollar still has significant liquidity premiums, which I think will continue to support its valuations.
Yeah, Jeremy, dollar yen dancing around 113 at the weakest since all the way back in December of 2018. Can we just blame that on higher yields, higher oil prices?
I think it's an extent of that. And as I say, I think it is that flow data as well. So we have seen those Japanese investors starting to export funds looking for those higher yields. I think, late last week, I did suspect that we might find it a little difficult to sort of run up through the sort of 112.25 level, and yet I come in this week and we're near a 113. So there is a sort of a degree of sort of washout of positioning. Dollar yen is getting towards sort of overbought extremes, so that perhaps might militate against sort of buying it aggressively up here. But I think if we do see any dips, there will still be some residual buying interest, because ultimately, as I say, those Japanese investors are still looking to export capital to benefit from that widening in Treasury JGB spreads.
Jeremy, thank you, sir. Got to leave it there. An important conversation, though. Jeremy Stretch, CIBC G10 FX strategy head. Tom Keane, the question of the moment I keep hearing, where do you find the safety right now with bonds and equities and that correlation picking up again?
Foreign exchange is boring, John. There's nothing going on.
There is now.
A big figure can be different things to different pairs, but you nailed it there, John, on Japanese yen. It is a 10 big figure move this year in Japanese yen. A weaker yen, 102 to 112 on dollar yen.
So where do you find safety, Tom, in a market where we're worried about higher yields, rallying crude prices?
How long have you known me?
Walk me through it. We've gone through the energy market. Let's go through the FX market as well. We've been buying the Russian ruble. That's what's got a bid more recently.
Well, I do not have a triple leveraged all cash fund set in ruble. I'll put it to you that way.
Priced in dollars, Tom.
It's priced in full faith and credit, sovereign forever dollars. But the answer is, where do you find an opportunity? Are you going to get in front of Turkish lira at an 8.96? Are you going to get in front of ruble with a hydrocarbon news flow? John, I like what we did with Swissy yen, some of these more esoteric pairs. Beware is what I would say.
I have no idea what the path forward has in store for us, Tom. But if I was worried about, if you told me energy up, you told me yields higher, I'd be thinking about
that simple.
Norwegian kroner, maybe a currency that's got that sensitivity to crude, a central bank that's likely to raise interest rates perhaps again. I don't know.
I go to the classic phrase, don't do this at home.
Been doing decently the last couple of months. I'm not suggesting a trade here. I'm just saying what's worked.
That.
Russia's worked. Ruble's worked. Norway's worked.
Norwegian kroner.
Okay.
I can see it.
Thank you. Jan Hatzius is coming up from Goldman. He had a revision on his growth outlook, a downgrade for US GDP. He delivered that over the weekend. We'll catch up with him at about 8:30 Eastern Time. From New York, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The price of oil went over $81 a barrel. West Texas Intermediate futures rose 2.7% to the highest level in 7 years. It is up about 30% since mid-August. The global power crunch is boosting demand for oil ahead of winter. Now, the power crisis is also squeezing aluminium. The price jumped to the highest level since 2008. Industry insiders joke that aluminium is basically solid electricity electricity. Each ton of the metal takes about 14 megawatt hours of power to produce. That's enough to run an average British home for more than 3 years. In the US, Merck is seeking emergency use authorization for a pill to treat the coronavirus. That brings the drug molnupiravir closer to becoming the first oral antiviral treatment for the disease. A study found it cut the risk of hospitalization by about half. Merck makes the pill with its partner Ridgeback Biotherapeutics. In Vietnam, factories are running out of workers to supply companies such as Nike and Gap in time for holiday shopping season. It's estimated that as many as 2 million workers will flee the country's industrial heartland in the south, the epicenter of Vietnam's worst coronavirus outbreak. In response, factories are boosting pay. Vietnam is the second largest supplier of clothes and shoes to the US. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
I think most of the reopening has already taken place, and we already see some softness in some services. So travel activity is kind of plateauing. Restaurant bookings are plateauing as well. We saw in last month's report that temporary help jobs were also softening. So I think there's a temporary pause in the services sector.
From New York City, for our audience worldwide on radio and TV, alongside Tom Keene and Katie Lyons, I'm Jonathan Ferro. Your equity market down 17 on the S&P.
Crushed.
We're negative 0.4%. On the NASDAQ, we're down around about 0.6%. That was Thomas Kosterg of Pictet. Tom, after a disappointing payrolls report, he was the man who was looking for it. He was looking for zero. We got 194. The range is massive. He came close to it, just 200K away. In the equity market, we're down 0.4%. Yields are higher by 3 or 4 basis points to negative 0.115%. Tom, a revision from Goldman over the weekend for the path forward. The path forward for this year, a small correction, but for next year, much more so.
Let's get to it. Our conversation of the day on market economics, the state of the American economy. Jan Hatzius joins us. He is with Goldman Sachs. Jan, I got 8 ways to go, but I want to fold it into a slowdown in the fiscal oomph to America. Did you adjust your GDP down because the fiscal party is over, the fiscal punch bowl is being taken away?
That's certainly the reason why we think the economy is going to slow quite a bit in 2022. We have it going to just under 2% by the fourth quarter of next year. In the near term, I think there are still some reasons to expect stronger growth. The trend is down, but I don't think it's going to be a straight line. We'll still get some boost from the receding Delta wave. Consumers have a lot of pent-up savings, and I think the inventory cycle is also going to boost growth. But these are all relatively short-term drivers. And going forward, further on, I do think growth is going to be significantly slower.
Whatever the flavor of inflation here, what does it do to the wage and the inflation-adjusted wage?
I think that really depends on whether you look at the top end of the wage distribution or the bottom end. I think at the bottom end, we've seen a sharp acceleration in wage growth. We think to about 6% if we adjust for all the changes in composition. And that's obviously, the strongest we've had in many years. I do think that the expanded unemployment benefits were a big driver of that. And now that those have ended, I think we'll see a deceleration there. But in the middle and upper end of the income distribution, we'll probably see continued gradual wage acceleration as the labor market tightens. And I still think it is tightening. So overall, we have wages going sort of roughly sideways in the 3.5% to 4% range. That's our current estimate of the underlying pace. And then the real wage, really is going to depend on what happens to inflation. In the short term, there is no real wage growth. In fact, real wages probably declining slightly because inflation is higher than that. Longer term, as you go into 2022, I think we'll again have real wage gains.
So Jan, just help me understand next year. 4% is the baseline for the year, but I'm more interested in the back half of 22. Are you saying 1.5 to 2% GDP growth by the time we get to the back end of 2022?
That's right. The 4% is in part being driven by the strength in the later part of 2021 that has a statistical carryover into the year. But as you go through the year, and especially into the back half, we have it at 3% in Q3 and then 1.75 in Q4. So definitely a trend towards slowdown, consistent with some of these temporary positives petering out as you go through the year.
Jan, how do you think the Federal Reserve will respond to that? Will they be looking at the cumulative gains that you've pointed out will still be decent in the labour market, or will they be worried about growth slowing back below 2%?
Well, so near term, of course, tapering is very likely to be announced at the next meeting. That's going to take until the middle of 2022. And then I think the question is, where is growth? Where is the labor market? Where is inflation? Under our forecast, growth is much more moderate, and inflation is on its way back down to something like 2% on core PCE. In that environment, I don't think they're going to move directly to rate hikes. And we have the hikes not starting until 2023. But of course, it's really going to depend on the data and how they compare with the criteria that the committee has laid out. They've been very clear about that.
Well, tapering isn't going to help much in reducing the supply side inflationary pressures that are out there. You could argue there's limited options for the Fed to do anything about that. Are the ripple effects, though, of that being more persistent than maybe expected, being underestimated?
The ripple effects from the supply side shortages, it's certainly taking longer. And I think that's pretty clear in the inflation numbers. I think a good indicator, it's obviously only one industry, is used cars, where auction prices again rose in September after several months of declines. So I do think in the next several months, we'll still have a significant inflation issue. We think core PCE inflation by the end of the year is at 4.25%, up from 3.6% at the moment. As you go into 2022, though, slower growth in demand and probably also a redirection to some degree of that demand from the goods sector. Right now, it's very concentrated in the goods sector. It's probably going to normalize somewhat, and some of it is going to move into services. I think that is going to result in relaxation, basically, of these supply bottlenecks and declining goods prices. But we're not there yet.
In terms of supply issues, we also have a real energy crunch out there in the world, and that has driven crude oil prices to now $82 a barrel on WTI. What is the real economic impact of crude north of 80?
I think, again, it adds to the near-term stagflation narrative. It's bad for growth, but it, at the same time boosts inflation. Mainly headline, there's not a major impact on the core numbers there. The high numbers there are really driven by other factors, but it's all pointing in the same direction in terms of weight on growth and making inflation higher.
Jan, long ago and far away, a younger Hatzius defined the housing market in America as we saw housing prices collapse. Let's go to your Brookings effort here. The balance sheet effects of the home price downturn. We need a rewrite. Jan Hatzius on the balance sheet effects of the home price upturn. What do you make of this boom, Jan? What does it mean for our viewers and listeners?
Well, I think it is one of the items on the strong side of the ledger, and one reason I think why we are getting a good amount of balance sheet support that is offsetting to some degree the negative fiscal impulse. But I think ultimately the negative fiscal impulse is probably going to be larger, in part because this housing boom, unlike the pre-2007 or 2008 housing boom, doesn't feature the same amount of mortgage equity withdrawal, home equity borrowing, cash out refis, etc. That was really a particular sort of way to turbocharge the housing wealth effect back then. We're not seeing that to the same degree now. So I also think the consumption effect isn't going to be as large.
Jan, just quickly, a final question. What do you make of this stagflation conversation that's taking place right now? What are you and your team telling clients about it?
Well, I think in the near term, it's real. If you just define stagflation as, deceleration in growth from the extremely rapid pace that we had a couple of quarters ago, and much higher inflation than we've had in several decades. I mean, it's just a description of the facts. The question is, I think, what happens as you go into 2022? And I think that's going to be a more traditional, sort of cyclical slowdown narrative, also with declines in inflation, but we're not there yet. And we're probably not going to be there for at least a few months longer.
Jan, just quickly then, just looking at the Fed forecast, real GDP next year, they're at 3.8, you're at 4. This is for 22. Core PCE, they're at 2.3. Jan, just quickly confirm, what are you at for 22 on core PCE?
So on for core PCE, by the end of the year, we're at 2%. So a little bit below the Fed's forecast. For GDP growth, we're at 3.3%. If you look at it on a fourth quarter to fourth quarter basis, right, is the way the Fed looks at it.
Jan, thank you, sir. I appreciate that clarification. Goldman Sachs chief economist on the path forward. Jan, thank you very much. Tom Keene, that's where we're at. I think the important piece of this for me, I don't know what you think, going into next year, is just where they see us landing at the back end of 22. That's a sharp deceleration, Tom, from where we are.
Everybody's guessing, as Jan Hatzius says,
of course
when
they
you look
are.
for the data. But, John, I love the idea here that you fold the fiscal slowdown into what the consumer's going to do and that estimate, and that comes right over to consumption in a huge part of the equity market. I mean, I'm sorry, but this is all linked in to speculation in the investment, say, of our retirement plans.
Goldman Sachs and Jan Hatzius with a small downgrade for 21 GDP growth and a bigger one for 2022. Coming up, Drew Mattis of MetLife Investment Management. Looking forward to that conversation. Tom Keene, Kelly Lyons and Jonathan Ferro. Lisa back with us tomorrow when the US bond market reopens. It's closed right now. Yields are higher in Germany by 3 basis points to just a negative 11 basis points on 10s. You keep asking that, Tom. Commodities up by more than 3% on WTI, just short of 82 right now at 81.85. On radio, on TV, this is Bloomberg.
I'm Danny Kleppinger with an exclusive BNP Paribas Open update from Tennis Channel. Sunday was a mixed day for the Grand Slam champions at the 5th major. Former Wimbledon winner Andy Murray turned back the clock as he came through an instant classic against Spain's Carlos Alcaraz. The 34-year-old showed no signs of his multiple hip surgeries as he fought for 3 hours before setting up a meeting with number 3 seed Alexander Zverev in the 3rd round. But it was a disappointing day for Simona Halep, who went down to Alexandra Sasnovich in straight sets. It was the Belarusian's 2nd straight win over a major champ after taking out Emma Raducanu in the 2nd round. And the number 2 seed Stefanos Tsitsipas showed his class as he moved into round 3. The Greek star taking care of business against Spain's Pedro Martinez. Up next for him, Italy's Fabio Fognini. And don't forget, Tennis Channel's daily live coverage hits the air at 1 p.m. Eastern. I'm Danny Kleppinger.
They know me as Magnus TV in Facebook since I'm streaming Axie Infinity.
Axie Infinity is an NFT game where you can earn tokens, and then that tokens can be converted into pesos. I'm playing almost 4 to 5 hours a day. I'm earning, I can say it's really a lot of money. It can help to sustain my family needs and also to sustain my own business that I'm starting. I'm a little bit worried about it because some people who join this Axie Infinity thinking that this is an easy money game. They can earn a lot on this game. This game can sustain their life. And I think that is not the point, or that is not really the game. We are trying now to build a community where other players or my scholars can join this esport, playing Axie Infinity for now, even 5 years, I think.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You look
drop
great.
the bow tie. Drop the bow tie.
What,
Drop
skinny
the bow
tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
How far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet
We might be.
that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh, my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
COVID is the enemy of everything, and it is absolutely the case in labor markets.
We're starting to get some signs that we're getting back to one labor market, but it's still not back to the way it was pre-pandemic.
In a stagflationary environment, they're going to tolerate that higher degree of inflation.
It's all about the hikes. I think the market now has essentially priced in the start.
I would not underestimate the amount of pent-up savings that exist right now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Kaylee Lyons in for Lisa Abramowitz. The bond market is closed. John Abramowitz says, I'm not coming to work.
She doesn't work when the bond market's closed, Tom, but it's open in Germany, it's open in the UK, and those bonds are lower, those yields are higher, and we're having a bigger conversation about gilt and the UK joining the likes of New Zealand, Mexico, Brazil, take your pick, Norway, hiking interest rates. That's the conversation in the UK right now.
Price down, yield up. And along the way, John, there's got to be touch points. A German 10-year getting to zero is a huge deal in this 13-year crisis.
It's painful for some PMs out there at the moment, Tom. Let's be clear. Bonds are lower, equities are lower, crude's rallying again. Can we talk about that 81, 82 handle on WTI? We haven't talked about these numbers, Tom, since the back end of 2014. It's been 7 years.
Well, it's been 7 years, but as the chart I used with Francine today is we had the gift of cheap oil for X number of years. Yeah, we've only come back to normal, John, when you adjusted for a lot of fancy math. But I'm sorry, we had to round it up $85 a barrel on Brent crude an hour ago. When do we say $90 a barrel?
I don't know. Maybe soon. And what does that mean politically speaking? Let's talk about the politics of 82, the politics of 90, the politics of 100. Got to have a bigger conversation about that too, Tom.
The bigger conversation, Kaylee, as we dive into earnings season. Kaylee Lyons, what do you see?
Well, oil is just one of the supply side higher prices that we are seeing. It's oil, it is shipping costs. A lot of these retailers are going to be in particular pain on it, and it raises a question of the margin pressure as we head into the quarter. We may not see it as much with big banks, but a lot of other companies, those in staples, for example, may have more difficulty passing those on and exercising that pricing power.
Let's stop the show right now. This is important. We're going to go to Drew Mattis, always optimistic. But, John, let me start with you. What did you think of how Jan Hatzius has framed the American consumer in his GDP markdown?
Look, back end of 22 is where it's at for me with that call from Goldman. If we get back to somewhere close to 1.5 to 2%, I wonder where it leaves this Federal Reserve and that conversation, Tom, about rate hikes over at the Fed. That's some deceleration on growth. And where's inflation in the mix too?
Exactly.
What does that look like?
And Kaylee, I was doing the math in my head while Jan was going on here about nominal GDP. No one's framing out, Kaylee Lyons, 2-3% growth and 2% inflation back to normal, essentially.
Yeah, well, normal, I think, is a relative term post-pandemic, Tom. But his whole point is that the consumer spending aspect of this is going to be delayed due to the Delta variant. But that comes back to the earnings conversation as well, because consumers have to be tolerant of those price increases in order for them to work. And when a consumer is facing higher prices at the pump, higher prices at the grocery store, some of that discretionary spending really comes into question.
On Columbus Day, we do a complete data check. The Dow Jones Industrial Average down 100 points, 34,534. John Farrow, the VIX explodes out 1.54 points.
Just to wind me up. Down 120 on the NASDAQ with negative 0.8%. The S&P down a half. NASDAQ is where some of the pain is at the moment. The epicenter for that pain off the back of this story in the bond market. Tom, you keep picking up the story in bonds. Let's talk about it. Yields higher by 3 basis points. We're having another little look at zero on German 10s. And let's be clear about this, Tom. That could be seen as good news for a lot of people, that we get away from where we've been in Germany for a long, long time, which is deeply negative through the bulk of this curve.
Yeah, there's no question about it. I mean, those dynamics are there, and it's how the central banks react. And, you know, I really wonder, with the complex politics that Lagarde has in Frankfurt, that meeting that's going to be
December's an interesting one.
More twisted and sensitive than the Fed.
The big one for the Fed is November. We assume they taper on November 3rd, right?
Well, yeah.
Next stop for the ECB is December. And, Tom, there's a debate taking place there about what replaces the pandemic emergency purchase program. I've got no idea.
I would think culturally and historically we'll have to see. Nobel Prizes today, we'll speak to one here in a moment. We are honored by his attendance. Right now we're honored by Drew Mattis with MetLife. Long ago at UBS, Drew Mattis made a shocking call in the gloom of a decade ago that an okay economy was okay for America. He nailed that call, and he joins us today on an okay American economy. Drew Mattis, explain how we prosper with just an okay economy.
Well, look, if you want big growth, big inflation, that's what we have now. Does anyone really feel good about it? And the answer is, of course, no. I think as we look ahead, what we need to see is we need to see growth coming down a little bit. Inflation, obviously, it would be better if it came down a little bit. But we also have to bear one thing in mind about inflation. It's not so much the level, it's the volatility that creates problems. So you can have a higher level of inflation over a persistent period of time, and it's not going to be as disruptive as if you have a slightly lower level of inflation that goes up and down by a dramatic amount every period. The earlier one, the former one, is easier to plan. It's less disruptive to hiring and less disruptive to investment.
Well, let's talk more about the hiring. What was your takeaway from the Friday jobs report and what it means for the Fed in November?
My takeaway from it was it wouldn't sway the Fed one direction or the other. If you look at the details and you look at the headlines, the headline payroll number missed, and everyone was upset by that. But if you look at the details were great. If you look at the unemployment rate number dropping, which people theoretically could like, wasn't really great because the participation rate declined as well. So it was one of those cases where the headlines were wrong. But the underlyings, offset them. It was just a mess of a report, and I think what it speaks to is there's a COVID story going on, there's an expansion of government benefit story going on, and then of course there are a lot of delays and shortages in the economy, which I believe are beginning to show through in hiring trends. right? There's no point in hiring a worker if you're not sure the parts are going to show up at the factory. And so, it kind of, it creates a delay throughout the supply chain where the factory is not going to hire the worker until they get the parts. The people making the parts aren't going to make more parts until they get the order from the factory. And then they're not going to hire people. And it creates this chain effect back through the economy that's really not a positive and represents a real threat to growth.
Let's talk about a positive, and it really is in the eye of the beholder. Drew, explain to our audience why you think higher interest rates can help, why they can be a good thing.
Oh, well, so Jonathan, you hit on my favorite topic. Zero rates at a policy level are incredibly distortive to economic activity. There has to be a price for risk. There has to be a price for, you have to get paid to save. And if you're not being paid to save, creates all kinds of distortions. I'll give you kind of just one great example. People have talked about the low inflation environment we've been in for a long period of time. Well, not if you're trying to retire, right? If you're trying to retire, if you include retirement or some sort of payment into retirement plans as part of the inflationary basket of goods and services that someone is buying, that's become a lot more expensive because the yields have been so low that you can't actually assume that you're going to get a decent return on your money for a long period of time. And so then you have to save more. And so ordinarily people think, oh, interest rates go down, people buy more. Not if you have a large cohort of the population moving towards retirement. When interest rates go down in that environment, they actually have to save more and buy less, and it creates a downdraft on economic activity.
Work with me on this then, Drew. If there's been some intergenerational wealth transfer from the eldest in society on the monetary policy side, can't we say the opposite on the fiscal side over the last several decades? Don't those two things cancel each other out?
I think we're talking about levels of scale. And of course, you can always, as we know, with the fiscal side, kick the can even further down the road. And, when we think about the environment that we're operating in with the United States, we have a lot of people globally who want our securities, right? Who want Treasury securities and are willing to buy them. One other concern I have with the low rate environment, and when you think about negative yields, think about this. Negative yields represent people being extraordinarily aggressive in terms of risk. No one, if they were going to buy a 10-year security of any kind, would actually take a negative coupon unless they were planning on selling it on, right? If you had to hold it to maturity, those things would never price at negative yields because no one's going to take that. And so what's really going on is that people are assuming that they're going to become even more negative yielding. And so they're basically making bets on how things are working. They're not actually buying because they particularly like the security.
Drew, I know you love talking about this, and you and I have gone back and forth on it in the past. I'd love to do it a little bit more in the future. You know that. Drew Mattis there of MetLife Investment Management on the current setup with monetary policy. A headline from Citi that would have been a bigger headline 6 months ago and now maybe just a reality for many of you. Well, Citi says Brent could hit 90 a barrel this winter. The reason I say, Tom, would have been a bigger headline 6 months ago is because right now we're about $6 short of that level at 84.32.
Yeah, this is a game, and the game is that Ed Morse, I'm going to say 6 months ago, John, was awfully lonely talking about $80 oil. I would give Jeff Curry credit there at Goldman Sachs as well. But, they changed their way along. Why didn't he go to $100 a barrel? I don't know. But he has a different approach. Ed Morse's approach is much more what I'll call geopolitical than we get from, say, someone like Amrita Sen. And for him to go to 90 is more a persistent 90.
We've got Morse, we've got the likes of Blanche, we've got the likes of Curry, Kaylee Lines, they're all lining up now, aren't they? The bulls in the commodity market.
Playing a little bit of a game of catch-up, John, as we're north of 80 on both WTI and Brent.
Kaylee Lines, Tom Keene, Jonathan Ferro, your equity market down 20. We're negative 0.5%. Up next, one of the 2021 Nobel Prize for Economics winners. Guido Imbens joins us next from New York City. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. It is the end of an era in private equity. The billionaire co-founders of KKR, Henry Kravis and George Roberts, are giving up their leadership roles. The two have dominated private equity for almost half a century. KKR's new co-chief executive officers will be Joe Bay and Scott Nuttall. The change is the final chapter in a succession plan that began back in 2017. Economists at Goldman Sachs have cut their forecast for U.S. growth this year and next. The bank blames a delayed recovery in consumer spending. Goldman expects 5% of growth in 2021 and 4% next year. Meanwhile, Goldman also predicts the equity market will continue to rally. A report says investors will gain confidence that the current pace of inflation won't last. The International Monetary Fund's Executive Board will deliberate today over the fate of its chief, Kristalina Georgieva. Directors have spoken with her and the law firm that allege improper actions in her previous job at the World Bank. Georgieva has denied any wrongdoing. And the US and the European Union plan to announce that at least 20 more countries will join a pledge to reduce methane emissions. Bloomberg's learned that Canada and Germany are among them. Methane is one of the most powerful greenhouse gases, but the UN has found that as much as 80% of measures to curb leaks from oil and gas operations can be implemented at no cost. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
What did you think at the low point of the Greek economic debacle? What were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms. And I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Google is saying it has accelerated innovation in the country and it's planning to appeal the FTC's decision. What's your take on this and how do you plan for further scrutinies?
We are going to see what they make and what changes they are actually bring to this market.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City this morning, good morning. On TV, on radio, alongside Tom Keane and Katie Lyons, I'm Jonathan Ferro. Lisa back with us tomorrow. When this bond market reopens, your equity market is negative 19 on the S&P. We're down 0.4%. Bond market closed at America Open in Germany. Yields higher there by 3 basis points. We're negative 12. In the FX market, euro dollar 115.73 and crude up 3 percentage points, just short of 82 at 81.77. So picture the scene. You have won the Nobel Prize in economics, but you don't know you've won the Nobel Prize in economics. And Tom, the phone rings. You live in America, on the West Coast maybe, and you're fast asleep. Do you pick up the phone?
Well, I don't know if you pick up the phone, but that is the great, great tradition, and maybe you miss it a few times, as Guido Imbens did this morning. Of the 3 winners here, this is the gentleman who did the hard work, the math out of Brown University in the house of Tony Lancaster. Guido Imbens has been definitive in econometrics. Think Clive Granger and Robert Engel of San Diego a number of years ago. Guido, this is an award for labor and the choices a society makes in trying to figure out jobs and wages. Discrete choice is the hallmark of your work. What are the modern choices we're making in labor in 2021?
Well, thanks for having me. So, I mean, first of all, it's just been great sharing this with Josh Angris and David Carr, because they've been such role models for me, and they've been so fun to work with and have as colleagues. And in addition, kind of Alan Kruger, who's also worked in this area, and all 3 of them kind of have been working on these really important substantive questions, and having been their colleagues. That motivated me to look at a lot of the methodological issues related to their questions, to make their answers more convincing and more credible, and hopefully more useful for policymakers.
I look, Guido, at the present work here, and the hallmark of this is to take David Card and Alan Kruger over to what Angrist and Imbens did in econometrics and math, over to the modern technology of Amazon, Target, and the rest, getting $16, $17, $18 an hour because they can't find labor. From where you sit, what does the marginal wage do to all of America with Amazon going out looking for the marginal employee?
Well, at the moment, I think it's all very much in flux after the pandemic, which has, of course, has had great effects on inequality, and it's had such an unequal impact on different parts of the labor market. And so I think Alan and David's work is still extremely relevant there, and I think the current administration is probably taking it very seriously.
Guido, obviously your work focused on natural experiments and the actual study of empirical data. As we talk about monetary policy and a Federal Reserve that wants to operate on actual realized data versus expectations, is that something that can only really be done with hindsight bias?
No, I think a lot of these methods are very relevant for informing future policies, and a lot of the the natural experiment literature has also made inroads into macroeconomics. There's incredibly interesting work going on there. Early on, Christian David Roma did very interesting work there. Nowadays, Emi Nakamura and Don Steinson are doing very interesting work trying to also tease out correlation and causality in macroeconomic settings where these questions are even more challenging than in the settings with microdata that David, Josh, and I have typically looked at.
Professor Emmons, what is so important here, and I think we'll do just one final question here as you go to your massive media day in celebration of this award. And the final question is, we have a certitude about data. It's in our economics, it's in our academics, it's in Wall Street, it's in everything to do with the financial media. You grew up in what I'm going to call the Bayesian house, which is real doubt over Knightian certitude. Are we too confident about our data that we're trying to guess the future on?
I think that's a super interesting question, and that's something that does occupy a lot of my thinking. We're trying to. I think traditionally we've certainly erred on the side of putting too much faith in the models, and so a lot of the methods I've been developing have been trying to get away from that and trying to make these methods more robust. But there's ongoing challenges in doing so.
Professor, before you run, did you miss the phone call? What time did they call?
Yeah, I missed it. I missed the first phone call. I got the second one. So I was. It'd been a long day before, so I was sleeping well, and I wasn't expecting this.
There you go. As is often the way, sir. As is often the way. They missed the phone call. Guido Immons, thank you, sir, and congratulations.
Thank you so much,
2021 Nobel Prize for Economics winner and Stanford University economics professor. Tom, they always miss the call. That's what I find always funny about this. They always miss the call.
Well, they do, and there's a great tradition here. First of all, the tradition is you have to be alive to win the Nobel Prize, which is the emotion over the late Alan Kruger. But far more than that, John, is the idea of picking a theme. And I think it is absolutely profound that they have selected labor as the focus this year, given where the real wage is. This raging debate, John, you and I deal with every day over, is labor power and labor strength finally back, and all of that then folding into our politics.
Real world issues that are applicable today. Danny Blanchard of Dartmouth has complained about this a lot when it comes to the Nobel Prize in economics, Tom, that they're esoteric ideas that you can't reapply to policy. And I think that's what you're getting at this morning. It's important for doing something for where we're at right now.
We have shocking access to these giants, folks. It's something we've earned over the years. And John, to give you an idea, David Card, who won today, wrote a profound, sharp, critical review of Blanchflower's iconic The Wage Curve years ago. I mean, they're all linked in together within labor and economics. And over, John, in the conservative wing from Stanford, as well as Professor Imbens, is the late Edward Lazier. So, you know, it's all linked in. John, there's another labor economist. Maybe you can get her on the phone today, but it would be good to speak to Secretary Yellen.
Oh, yeah.
About all of these people today.
I'll get her on in the 9 o'clock hour.
Yeah.
I look forward to that. Of course, we're all thinking, Tom, of the late
I'm out front.
great,
I'm booking for you, John.
All thinking of the late, great Alan Kruger.
Yes.
On a morning like this morning, that's for sure. Good morning to his family, if they're listening or if they're watching. Equity futures this morning down 16 on the S&P. We're negative 0.4%. From New York City this morning with Tom Keene, I'm Jonathan Ferro, together for one day with Katie Lyons. Lisa will be back with us tomorrow when that bond market
and I are together for one
reopens.
Day. Great.
That's what people are hoping, Tom. That's what they're hoping. And then we disappoint them every morning at 6 a.m. Eastern Time. Yields higher by 3 basis points on Burns, getting back to negative 12 basis points. Your commodity market, that's where there's a build. It's higher again, 81.65 on WTI, advancing there 2.9%. This is Bloomberg.
people. They don't know what to say. Again, they can't even fathom that they're out of Afghanistan. They're still in a state of shock and can't believe it.
Built through this process is essentially a mechanism for getting oppressed women and girls out of Afghanistan. So we're actually going to circle up and see what resources we have left, to see what options we have left, what mechanisms we have left, and actually look at potentially trying to get more women and girls out of the country as well.
Through a lot, us as a team. I know sleepless nights, but you know what? There's nothing more satisfying than knowing that you've saved many lives, and will continue to support these girls on their missions.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
From New York City for our audience worldwide on TV and radio, alongside Tom Keene, I'm Jonathan Ferro. Katie Lyons with us this morning. Lisa back with us tomorrow. Here's your equity market as we kick off a brand new trading week. Earnings begin on Wednesday. Equities lower by 16 points, down 1/3%. Yields higher on bonds by 3 basis points. On a German 10-year, negative just 12 basis points. Foreign exchange not doing much for me in the commodity market. There it is, 81.36, call it 38. We're positive there, 2.6%, Tom.
Yeah, John, but we gotta scope this out. I mean, I think people have a pretty good idea of the 10-year yield from a 112 up to 161 and the memory of a 170. The German number to our American listeners and viewers, John, is pretty much foreign. The answer is it was massively negative, and it's almost back to zero.
Getting back to zero and seemingly having another look at it. We did that a little bit earlier this year. Let's be clear about that. We topped out on 10s on treasuries at 177. Quarter end, first quarter. German bonds getting back close to zero. Going to be interested to see, Tom, what that PEP program of the ECB gets replaced with. How much flexibility it has, how much weight it has, and what it does for this bond market.
Yeah.
Maybe more targeted at the periphery than, say, the core.
That's the European ballet. There's the American ballet, and then there's the ballet coming up, folks, on earnings. We've really not touched on that today. Today we dive in with Michael O'Rourke, Jones Trading Chief Market Strategist. What do you expect? I mean, what is the O'Rourke expectation of Wednesday on to, say, the next 3 weeks?
I think we're going to see a lot of what we've been seeing for the second half of this year is corporations talking about input prices being high. You're seeing their margins getting squeezed. And it's just overall, it's a lot of uncertainty about where the real trend of earnings is and where the real earnings outlook is.
What's the history of what we get wrong when we're in this spot? Do we get wrong down the income statement? Do we get wrong revenues or part of revenue dynamics? What's the misstep you've got your radar up on?
Well, I think the revenues are good. Like if you listen to all the companies out there, they talk about business being strong. The most interesting aspect, like we've seen develop over the past 3 or 4 weeks, is now their customers have stopped ordering because they can't get other component parts, so they can't build things. So now they've just stopped ordering for the future. An interesting story out last week was advertisers have stopped advertising because they can't make their products to sell. So I think so the revenues, the demand is there, everyone's saying. It's just you can't get the components, you can't get the products off the line in order to sell them. And that's where that's obviously becomes the whole supply chain distortion issue we're talking about.
Mike, I just want to know what to do with the banks. They've rallied so hard off September 22nd. We've got JP Morgan starting things on Wednesday, Thursday, Bank of America, Citi, Morgan Stanley, Friday, Goldman. Mike, what do you do with the banks now?
I'm still a big fan of the banks. I've been a big fan of the banks every time I've come on. I still think we're still sitting here with this low interest rate environment where we are going to see higher interest rates in the future. And I think that whole reflation recovery trade is still ahead of us. We've had about 15 years of massive growth outperformance. It worked even better during the crisis. And then about a year ago, we saw that relationship bottom where value started to come back. And then in the hiccup of the past 6 months, Ed, you mentioned how Treasury yields peaked at 1.7%, 77% in the spring. As rates came back in, the banks and other value trade components came back off, or they corrected, I should say, and underperformed growth. I think they're ready to outperform again. So we'll see when we get these bank numbers, but I'm optimistic about their environment going forward.
Do they do well on higher rates regardless of what is driving higher rates?
I think, I mean, the fact that they, in my opinion, have done very well in, obviously it's not a very flattish yield curve environment. When we start seeing some meaningful steepening emerge, I'm excited to see that. It's funny, before I came on here, we talk about policy rates. You had Jan Hatzius on talking about the economy slowing down to about 2% at the end of next year. The Fed's long-term Fed funds target, going back since they've been publishing the summary of economic projections, actually, I know it was even higher then, but I think going back to probably 2008, no, it's 2.5%. We haven't been at 2.5% since 2008. So when you think of the yield curve steepening that we're due to have eventually over time, I think it plays out really well for the banks.
So it may play out well for the banks, Mike, but what does that mean for growth stocks?
Well, I think growth stocks have had an incredible run. It's just they've been the winners. They've been the drivers of this bull market. I think we're starting to see some cracks emerge that there's probably better places to put your money going forward. These companies have driven the bull market. I think it's time for people to look elsewhere and be a little more defensive. And like I said, if you want to be invested, I would shift towards those value names.
Does that include energy? The S&P 500 energy sector up 83% year to date, still though lagging oil with WTI up nearly 93% on a year to date basis, Mike.
Yeah, it does include energy, and there's so many interesting dynamics here because there's a very political dynamic here in the United States as far as the talk about debanking energy and things like that. You're seeing some investors buy stocks or buy the commodities, go into the space because they're worried about the shortages that we're seeing right now. And that scarcity value is making the sector more attractive. So, and then from a valuation perspective, relative to other parts of the market, energy does look good. So whether it's energy, materials, yeah, I think you want to be in those spaces, for the time being.
Michael, I want to focus on what John Farrell brought up, which is the massive ambiguities of rates and inflation grinding higher. I would suggest the media makes it a very simple discussion. It's not. For people that are exposed to the stock market, list the ambiguities that can happen as we go to a new rate regime.
Well, I think, like you said, new regime is such an important, way to describe it. We've been in this current regime for probably since 2008, 13 years or so, where it's a low interest rate environment. And what we've talked about, or what investors have talked about, is there's no alternative, right? So the lower rates are, you can put a higher premium on PE, on valuations, you can pay a higher PE. And now if we're seeing this regime shift again, and it's funny, when we talk about the 2013 taper tantrum, we talked about the 10-year yield, and it gets a lot of attention, but the 10-year yield went from 1.5% to 3% in 6 or 7, 8 months, right? We're not even, we're trying to, you know, we just moved above 1.5% here. So what happens is now you have to take your multiple down on the market. If you look at the environment in the early, the 70s and the early 80s, right, where interest rates were high, you had very low multiples. So that's the risk here is now as you start, if we actually see interest rates normalize, which we're not even close to yet, I would say we're talking about not policy tightening, but policy firming. Then you have to start taking your multiples down. And that's what put those growth names at risk. You know, longer term. I'm not talking about over the next month or 3 months or 6 months. I'm talking about the next 5 years.
Okay, and John, this is the set for the next 2 days as we stagger to J.P. Morgan and the Diamond launch of earnings season. And John, this goes to, say, Mike Wilson at Morgan Stanley, cautious, Costin at Goldman Sachs, I'm going to call a relative bull. Then there's Dwyer. We won't even talk about Tony Dwyer off the edge of bullness. And John, it goes to Lori Calvasino, who I know you've got coming up in the 9th. All these nuances lead from the massive ambiguities of what's going to happen.
Lori likes the banks, and that's the sector of the moment, and we'll be talking about it all week. What I asked Mike was, do you like the banks on higher rates regardless of what drives higher rates? Because the move that we saw at the start of this year from 90 basis points through to 177, through the first quarter, Mike, that was on accelerating growth expectations. Literally every single week, it was like upgrade after upgrade to the outlook for GDP in America. It's different this time around. We're seeing high yields without a corresponding pickup in growth expectations. I'm trying to understand if the banks trade still works in that environment.
I think it does, because I think that rate move is important. I mean, I think they've had an impressive year considering rates came back down. My view of the big move back down in interest rates was Chairman Powell deciding that, you know, despite the strong economic data we had, we had not made substantial further progress. So I think that's what you know prompted the bond market to rally again, pushing yields back lower again. I think again that was a hiccup or a pullback. But I think we're looking at that environment where we're going to see yields go higher in the future. And it's not so much, I mean, we've had this impressive rebound economy, but that's what happens after you have a massive contraction. And we've had all this fiscal stimulus and monetary stimulus thrown at the economy. So, of course, there's going to be some type of hangover going forward. And again, that's a risk to every business out there, not just the banks. But, you know, the fact that the banks performed so well the past year in a flat yield environment, or low yield environment, is what really impresses me to think that as we get more to a normal economy, things will be better for them. And even when you talk about Jan Hatzius is talking about the economy slowing down to about 2%, that's trend growth. That's the Fed's trend growth as well. So that's where we're supposed to be.
Mike, got to leave it there. Good to catch up, buddy. As always, Mike O'Rourke there, Jones Trading Chief Market Strategist on the earnings season that is about to begin unofficially this Wednesday with JP Morgan. The bank's always first, Tom. They kick things off later this week.
Well, they do, and it's a clarity of it. And I really want to make clear, yes, we know that all the banks are different, but their conference calls are different too, John. And I'm going to suggest not just bank analysts, but the street as a generalization is going to be on the edge of their seats for the JP Morgan analyst call and the media call with it as well. It'll be interesting to see if Mr. Diamond participates, but people really want to get a sense of their tone, and frankly, not even Q4, their tone into next year.
Katie Lyons, we have rallied hard into these earnings on these banks year to date and over the last couple of weeks.
Yeah, sky high expectations, John, and it raises a question. Can the fundamentals from an earnings perspective support that, or are the banks even that tied to the fundamentals? Is it more about the macro story, to your point, what you were just discussing with Mike? If you have higher rates, that's going to benefit the banks, and everything else maybe doesn't matter quite as much.
Katie, thank you for putting in a long shift and working hard.
My pleasure.
Appreciate it. Katie Lyons there. I don't, for good reason. Tom Keene and Jonathan Ferro. Lisa back with us tomorrow. Your equity market softer by 0.2%. Top of the hour on Bloomberg TV. Lori Calvasino of RBC Capital Markets on this equity market run. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The price of oil went over $81 a barrel today. West Texas Intermediate futures rose 2.7% to the highest level in 7 years. It is up about 30% since mid-August. The global power crunch is boosting demand for oil ahead of the winter. The power crisis is also squeezing aluminium. The price jumped to the highest level since 2008. Industry insiders joke that aluminium is basically solid electricity. Each ton of the metal takes about 14 megawatt hours to power to produce. That's enough to run an average British home for more than 3 years. Now, Chevron has set a goal of net zero emissions from its own operations by the year 2050. The energy giant is responding to rising pressure from investors and society to play a bigger role in the change to a low-carbon future. It is the first time Chevron has outlined such a long-term strategic commitment on emissions. Hong Kong's chief executive is defending coronavirus travel restrictions that are frustrating global businesses. In an interview with Bloomberg TV, Carrie Lam signaled the curbs will stay in place for the foreseeable future, even while Singapore allows more quarantine-free travel. She says that mainland Chinese officials want Hong Kong to follow their own strict approach to wiping out the virus. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
So the 1972 Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones, really, for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses because we have a captive audience. We have people home that really want something to do and need entertainment, so we do our best to try to give it to them.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
Question is, I think, what happens as you go into 2022, and I think that's going to be a more traditional, sort of cyclical slowdown narrative, also with declines in inflation, but we're not there yet, and we're probably not going to be there for at least a few months longer.
Jan Hatzius of Goldman Sachs are an important discussion as well. Kaylee Lyons and Tom Keene on a day of economics to celebrate the Nobel Prize winners. We are honored that Professor Imbens from Stanford University could join us earlier. So we talked to a Nobel laureate. We talked to Hatzius of Goldman Sachs. Let's talk to somebody who's got their thumb on the pulse of the American economy. We make light of it, but the charge card companies led by MasterCard, and I truly mean that, the MasterCard Economic Institute, do hyper granular work on modern America. Bricklin Dwyer out of Yale and Columbia leads the charge there, and we're thrilled he could join us this morning. Bricklin, your work gets laughed at, but it's incredibly important right now about the pulse of America. What does the MasterCard work say about small business?
Well, it's really fantastic. Some of the analysis we pulled out of the, this pandemic, we've seen small businesses underperform large by about 10 percentage points during the crisis. And, of the businesses that closed during the crisis, small businesses were about 3 times more likely to stay closed than large. So that was about 1 in 4 small businesses. So a pretty significant impact as we all talk about, small businesses taking the brunt of the impact, but it really was substantial.
They will, and they must go digital. We see this in all the cardboard boxes and the acclaimed cardboard box shortage as well. Does small business have the ability to deliver the box the last mile?
Well, I think that's what a lot of small businesses around the country and around the world have been trying to figure out. But we've seen that rate of digital adoption really increase substantially. We've seen that number triple in 2020, really driven by the restaurant space, then services, then retail. So people are figuring out how to, get their food online. They're figuring out how to get their services and then their stuff. But of course, a lot of folks already had their stuff online.
Well, Bricklin, we were talking to Jan Hatzius over at Goldman Sachs earlier. He downgraded his growth forecast for this year and next due to a delay in the return of consumer spending, basically because of the Delta variant. If consumers aren't out in the economy going to their local small businesses, how much damage does that do at this point in the recovery?
Well, so I think that, that the trend in spending right now still has been very robust. I think what Jan is referring to is the sustainability of that spending. As we get into next year, fiscal stimulus starts to fade away, and some of that organic need for business creation and wage growth really needs to hold up the economy. So that will really be the test. But thus far, we've seen a really strong pace of spending, even as businesses have been reopening and people have been going back into those small businesses. That really has been one of the key drivers of people spending right now.
Well, and people in their spending have had to be tolerant of price increases really across the board due to the higher input costs that a lot of businesses are dealing with. We talk about that on a large kind of corporate America scale as well, but how is Main Street and the local small businesses grappling with some of those supply side issues?
Well, it's tough. If you're a bigger company in the U.S. today or in the world, you have a lot more buying power to get that product that you need. So it makes that even that much harder to drive sales for small businesses today. So that really is at the crux of the challenges that small businesses face for 2022.
Bricklin, this day of the Nobel Prize in Labor Economics, we've been looking at the marginal wage. As you know, at MasterCard, you've got Amazon $17, $18 an hour, Target, Costco, all the rest of the big employers as well. Do you do any research on the wage dynamics and the ability to get the marginal employee for small business?
Yeah, absolutely. You know, there's a lot of competition for that marginal employee today, and trying to get that extra person at the counter, extra person working to really drive that creation. But there also has been a tremendous amount of attraction for folks to work at small businesses.
Yeah.
If you look at the number of small businesses that were created in 2020, there's about 86% gain from 2019. So there's a huge opportunity to get involved in new businesses, new ideas that really try to capture that digital economy as well as that Main Street economy of the future.
Let's get out front of the news. What's the MasterCard call in the holiday season? Don't give me a bunch of Grinch stuff here. Give me some Santa. Come on.
No, it's really good. You know, we estimate that the season could bring about a gain of close to 7.4% for the year. So those are really good numbers. If a normal season is somewhere between 4 or 5% growth, we're seeing that really strong holiday season going into the end of the year. Again, a lot of questions on the supply side, but really consumers are spending right now, and it is a pretty healthy economy.
Bricklin, thank you. Bricklin Dwyer, important research with MasterCard, really legit research on the granularity of small business in America. Edward Morris is publishing with a storm this morning at Citigroup. There's talk of copper. He does it in LME terms where he resets where copper is right now. But Kaylee, I don't really know the timeline here, if it's 1 year, 2 years, even 3 years, but his bull case for copper is a 20% plus move. It's sort of opaque to me, but nevertheless, there's the bull case. Much like oil to 90, oil to 100, copper comes right along.
Well, you're seeing it really across the commodity complex, with aluminum at a record, iron ore up 50% in just the last month or so. But with copper, it's interesting, Tom. I would have to imagine this is kind of a longer term case here, because in the near term, you're starting to hear more strategists talking about the potential downside in the near term for copper, given the fact that power shortages are impacting production in a lot of places in the country. So in the near term, it could be a lot bumpier for this metal in particular, even if on the longer term it is bullish as we undergo a green transition and talk about a recovering global economy.
I'm going to go, well, that's the point. I'm going to go to the bull proxy here, which is on Pacific Rim in Asia. And with copper, you know, not that we're the authorities on this, but it appears to be much more about demand elasticities out of China and the Pacific Rim. And all of it, Kaylee, is hinged on Asia recovery.
Yeah, and China recovery specifically, Tom. And you also have to consider when talking about commodities that China is attempting to undergo a green transition. It wants to reach carbon neutrality by 2060. We know already that has had a real impact on iron ore, given some of the steel production curbs that China has put into place. But it's had to walk a lot of that back due to the supply shortages, the power crunch in particular China is dealing with, telling coal producers, hey, forget about your annual quotas. We just got to power this country in any way, shape, or form. So it's definitely an interesting conversation in that part of the world.
Kaylee, thank you for joining us on Columbus.
Thank you for having me, Tom.
Great to have you.
Bond market's closed, if you haven't heard.
Bond market's closed. I have heard that now. And, you know, it's Columbus Day and it's supposed to be quiet. It is not. What do we have? We have a Nobel Prize in economics, in labor economics of Card, Angrist, and Imbens as well. Thank you, Professor Imbens, for a first call from Stanford and Palo Alto this morning. With that also, yield market moving and the anticipation of what we will see, I believe it is Wednesday, on earnings. Another laureate in the 12 o'clock hour, Paul Romer, on the World Bank and the IMF. This is Bloomberg. Good morning.
OECD nations need to end coal use by 2030. Developing nations need to follow suit by 2040. And we need coalitions of solidarity between countries that still depend heavily on coal and countries that have the financial and technical resources to support transitions, because it is essential that no more coal power plants are built.
Bloomberg surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You
drop
look great.
the bow tie. Drop the bow tie.
What, skinny tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
A big week ahead from New York City for our audience worldwide. Good morning, good morning. Equity futures negative about 0.2% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue, the beginning of the end of easy money.
That test has been met?
Absolutely, yes. We're still squarely on track for the Fed to taper.
In terms of the amount of stimulus we're getting from central banks.
The easy money.
We're close to peaking.
Central banks want to take some of the largesse back.
The field's been tilted too long to borrowers. It's time to tilt it back to savers.
Inflation is going to run hotter and for longer.
There's longer-term transitory inflation.
It's transitory inflation going on for longer.
This is why the Fed is, has signaled imminent tapering.
Easy money.
As we look down the road, that's going to ebb a bit.
Joining us now, Jim Bianco of Bianco Research, RBC's Laurie Calvasina, and Colin Martin of Charles Schwab. Laurie, I want to begin with you. That concept, the end of easy money. Does that resonate with you, Laurie?
It does, but I think, to be honest, John, we've been digesting this since March. If you look back in March, we saw value in small caps peak relative to the broad market, and that's something we would have expected to see once tapering began. So it does resonate with me. I think it's contributing to jitters, but I do think we've got a lot of the indigestion out of the way already, to be honest.
Jim Bianco, do you agree?
Sort of. I do think, the Fed wants to pull back and will try to pull back, but they learned the lesson from 2018 when they used the word automatic pilot and the market rejected it. They're very flexible. They'll make an announcement that they're going to taper, but then if there's an off-ramp, they'll take it in the future.
Colin, we've had hikes from Norway, Brazil, Mexico, South Korea, New Zealand. A conversation this morning that maybe the Bank of England will join them at some point over the next 3 to 6 months. Do you see things starting to build here that could bring the ECB in, the BOJ in, the Federal Reserve in, because those three seem to be sitting this out?
We could see that, John. Like you said, we're seeing a lot of other central banks getting closer to less easy policies. Like you said, the BOE, we're seeing, inflationary concerns there. some headlines about governors there maybe pulling forward the timeline of that first rate hike. Like you said, we're not seeing those with some of the, the big three central banks in the U.S., ECB, and Japan. But overall, we are getting closer to less easy policies. We do think there's a difference between less easy and tight. We're likely still a long ways away from that. But we do think the Fed will likely announce the tapering next month, and a rate hike could come next year.
Will
So
the higher prices, hey Colin, to jump in, I think the bigger question right now for this market, will the higher prices compromise these central banks' ability to support this economy, to support this market? This came from Bank of England's chief economist, Hugh Pill. He wrote the following: balance of risk is currently shifting towards great concerns about the inflation outlook, as the current strength of inflation looks set to prove more long-lasting than originally anticipated. The reason I bring up the Bank of England here, Laurie, I think the same I emphasize, may apply at some point to the Fed as well. We're looking at higher prices and we're now asking a different question. Will it compromise the ability of these central banks to continue supporting growth, to continue supporting markets? Do you think it will?
Well, look, I agree with the point that there's a difference between less accommodative and actually tight. And I think we're a long way off from being actually tight. But, John, we did actually do an investor survey last week, and we found that investors on the equity side, there has been a fair increase in those who are expecting the first hike by the Fed in the middle of next year. So I do think that concept, the idea that the Fed might have to move earlier than initially anticipated by a lot of investors, I do think that has been starting to get baked into the market as well and contributing to some of the recent indigestion we've had. But, I think we're a long way off from saying that they'll necessarily, sort of kill the economy, so to speak.
Laurie, you mentioned something really important. We've been talking about these issues now for a while. Not just central banks moving the other way, but also supply side issues too. Increasingly every morning, I'm having the same conversation now. Upside risk to inflation, downside risk to growth. Now we start to have a bigger issue around margins going into earnings season. How well priced is that right now for you, Laurie?
So I think that what is starting to get priced in, if you look at the materials sector and in the industrial sector, we have just seen an absolute collapse in the rate of upward revisions, which is the main way to look at earnings sentiment. So I think investors for those two specific sectors really are anticipating sell side numbers needing to come down. It's not to say the valuations are cheap. I think industrials are still expensive, but I think that's well understood. I think that when we start to look at the rest of the market, you're seeing areas like technology with very strong rates of upward revisions. We've seen some deceleration in consumer discretionary, but not a big collapse like we've seen in industrials and materials. I think it's those other areas of the market that are perhaps less in the crosshairs of supply chain issues where we haven't seen an impact. And the question is going to be, does that pain in the industrials and materials space spread to some of these areas that have simply been more resilient so far? That's where the real risk in this reporting season lies, the idea that pain is not concentrated but spreads.
Larry, I want to talk to you about the banks as well, Laurie, a little bit later in the hour around the opening bell. Need to talk to you about energy too. We've got crude back to 81 on WTI. We had a little look at 82 plus earlier. Brent crude at 83, just south of 84. Both of those, Brent and WTI, have been rallying really hard. Laurie, establish the relationship between what's happening right now with crude prices, the correlation between energy and the broader index too. What are you seeing that you think is worth paying a bit of more attention to?
So, look, I think that as we've seen this market leadership shift from the big tech companies and the secular growers back to energy, back to financials, there's simply not enough weight in that energy and financial space to just sort of empower the S&P 500 to have this explosive move higher. It's been trudging along, perhaps better than I would have anticipated. But what we are starting to hear, John, as we're getting closer to reporting season, investors are starting to get a little bit uncomfortable with this energy price move. So we're starting to get questions on how is this going to impact margins for the broader market. We frankly think that it's kind of an earnings wash. It benefits the energy companies. It hurts other companies in other ways. Not hearing a lot of chatter about that yet, but I think that's something we have to watch for in this upcoming reporting season, the extent to which these higher energy prices are pinching corporate profitability in other sectors. Haven't heard a lot of it yet, but that's another risk we've got to look at.
Hey, Colin, I imagine we're going to hear more about it. And my apologies for cutting you off earlier. A bit of a problem on my end hearing you. Colin, just weigh in on that if you can. The correlation between risk assets and what's happening with energy prices at the moment.
Well, one benefit of the high energy prices and still rising is that energy junk bonds have done really, really well this year. They've been the strongest performer in the whole high yield market and have helped drive total returns higher. But now when you look at the market as a whole, spreads are still low. There's very little juice left to squeeze. And while those benefits are flowing into energy companies, it's a risk for everyone else in terms of higher prices, higher supply prices, all those things we're hearing about in terms of shrinking margins. So it's getting us a little bit more cautious on the riskier parts of the market, especially triple C's and junk, where there's just very little room to move higher. And if we see these supply chain issues continue longer than expected, that's going to be challenged there, and we can see prices fall.
Jim Bianco, can you add to that, if you can, please?
Yeah, I think the supply chain issues are going to be the most important thing to look at going forward from here. Look, they're already lasting longer than most of us ever thought. They're probably at their worst point right now, and we're not looking at any sign of them turning around soon. I think it's a function of too much demand, overstimulation by governments and central banks, and they seem committed to continue to do it. I know we've talked that around the edges they might be starting to pull back. And my fear is that that's going to lead to the old adage that the cure for higher prices is higher prices. And wait till you see how high these prices have to go, especially energy, to cool off demand.
Higher prices weighing on demand. Let's have a look at a Goldman call this morning and work through it together as well if we can, Jim. This came from Jan Hatzius. I caught up with him a little bit earlier this morning. After updating our estimates of the key growth impulses that drive our consumption forecast and incorporating a longer-lasting virus drag on virus-sensitive consumer services spending, we now expect a more delayed recovery in consumer spending. They're now looking for something closer to 4%, the line in the sand for them next year, down from 4.4. It's a small revision this year to 5.6 from 5.7. But Jim, one thing that stood out for me is that they think we get back towards trend 1.5 to 2% by year end next year, back half of next year. When you talk to clients at the moment, Jim, are they discussing that sharp deceleration back to 1.5 to 2% next year?
Well, they are discussing this deceleration in the economy. I don't know if they're all at the same level that they're thinking about trend growth, but there's definitely been a disappointment, especially in the third quarter when you look at most of the numbers. The Atlanta Fed has got GDP down around 2% or so, and we expect that to pick up in the fourth quarter and the early part of next year. But there is a slowing of the economy, and it isn't moving along at the level that we were thinking even 3 or 4 months ago.
Reason I bring that up, Jim, is because, Laurie, you're really constructive next year. You're looking for this choppy story through year end and constructive through 22. What's the anchor that underpins that constructive outlook for the equity market from you, Laurie?
So look, we're looking for about a 9% move next year. So a strong year, a solid year, but closer to trend than what we've gotten this year. But look, I would say if you think about sort of the economic bones of this market, they still look to be incredibly strong right now. If you take that forecast downward revision you just mentioned, going from 4.4 to 4%, that's still very, very comfortably above trend for a bit longer. And so part of our call has been we're going to see this value resurgence last probably until the middle of next year. But we actually don't disagree with the idea that we want to shift back towards growth in the back half of the year as we get closer to that trend-like growth. And I'll tell you, John, markets have already been anticipating this deceleration. If you look at 2023 GDP forecasts, they've already been hovering around 2.3%. And so that sort of move from 4.1-ish to 2.3-ish, which we were seeing in the consensus last week, not updated for these numbers, of course, but that was already saying we'd get a hot economy next year. You have some time to play these cheap cyclicals like financials and energy a bit longer, but there is an expiration date on the trade. And that's just naturally what we're doing. This is a pretty typical playbook, to be honest.
Colin, build on that, just as a final word from you, sir. The road back towards trend growth. Colin, what does it mean for you?
Well, we're still positive. I want to agree with Laurie's points. The underlying fundamentals of the economy are still strong. And what we're looking at is the strength of the consumer. What we've seen, given all the fiscal stimulus, is a lot of savings and paying down debt. And that means that there's plenty of money out there. So maybe the pace over the next few quarters slows, but spread out over the next year plus, year and a half, there's plenty of spending and buying power out there. So we're still really favorable. We think growth can continue to remain relatively high. Decelerating growth isn't necessarily low growth. I think that's important. And inflation can remain high. So ultimately that leads to our point of higher long-term treasury yields. We're targeting around 1.75% by the end of this year and 2% maybe in the first half of next year.
Colin, thank you, sir. Colin Martin sticking with us alongside Jim Bianco and Laurie Calvasina. This administration looking for higher taxes. Secretary Yellen telling ABC she expects Congress to follow through on a global tax deal.
It will be passed, and we will be able to reassure the world that the United States will do its part.
The latest from D.C. Up next from New York City, This is Bloomberg.
Dealing with that blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours, and renewables. We have a very strong climate component in our government and in our government programme, and that, of course, is not disconnected from the energy agenda. And there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Confident that what we need to do to come into compliance with the minimum tax will be included in a reconciliation package. I hope that it will be passed, and we will be able to reassure the world that the United States will do its part.
Government's coming to an agreement on a 15% global minimum tax rate, with 136 countries pledging their support. Ireland, the last to cede, with Finance Minister Pascal Donohoe saying the clarity is there.
Earlier on in the year, I did believe there was the possibility that that figure could go up. That is the reason why Ireland could not enter the agreement then, but now it is 15%. I was making the case for that kind of clarity, that kind of certainty. It's now there.
It's now there. For more, here's Bloomberg's Michael McKee. Morning, Mike.
Morning, John. Important to recognize, though, the treaty is not there yet. More on that in just a second. But here's what the treaty is. It has two pillars. It's not just the 15% minimum tax, but it's also about where companies are taxed. Companies will be taxed where they sell, not just where they locate. In other words, if an Amazon sells something to a customer in France but doesn't have a location in France, it'll still pay French taxes to the extent that their profits come from that area. This will apply to a lot of big American companies, in particular, companies with more than 20 billion euros in revenue and margins above 10%. There is a carve-out for oil, gas, mining, and financial services companies, however. The second pillar is the 15% global minimum tax. At one point, it was no less than 15%. Ireland objected to that and wants it at 15% or higher. It affects companies with more than 750 million in revenue, so that's a little bit less than the Pillar 1. And it will lead countries like France, which has a digital service tax, to drop them effective immediately. However, this deal is not effective immediately. Here's the thing. It'll be presented now that the working groups have finished to finance ministers meeting in Washington this week. And then it goes to the G20 leaders, who will be meeting later this month. You can see that this is going to be something that they're all going to have to agree on, because some of those countries, like France, pay the very highest tax rates. The U.S. is in the middle, but trying to raise theirs a little bit. 67 votes are needed, John, in the U.S. Senate to amend a tax treaty. And you know as well as I do, that means that the Democrats will have to come up with a significant number of Republican votes, and Republicans not very anxious to change the tax code these days.
You think, Mike, that's the international tax story. Talk to me about the domestic one. What's next here?
Well, the reconciliation bill contains the Biden administration's tax proposals, and it does raise taxes on the wealthy. The question is, how soon do they bring that to the floor? They can use the reconciliation process to get around the filibuster and just pass that one with 51 votes. It's actually the Democrats who are divided over exactly what tax provisions go forward.
And Mike McKee, thank you, sir. Let's talk about taxes with Jim Bianco, Laurie Calvasina, and Colin Martin. Jim Bianco, for much of this year, through the first quarter, DC was a tailwind. Keep going back to this question. Just quite simply, from your standpoint, your perspective, is it now a headwind?
Yeah, I definitely think it is a headwind. There's no real agreement in DC about what to do. As you mentioned, the biggest argument right now is it's Democrats among Democrats because the Republicans have been left out because they're the minority of both chambers of Congress right now. So as we move forward, we have to ask whether or not the reconciliation package will look anything like we think it does today. We couldn't get it passed, and that's why we had a debt ceiling push until early October. As far as the international tax agreement goes with the treaty, the estimates that I've seen is that it's maybe 10 years away from happening. It's not going to happen right away. 136 countries have to ratify it. That's not happening overnight. So this is going to be a very long slog. And in the middle, we're going to have a lot of uncertainty and we're going to have a lot of confusion moving forward.
Colin Martin, your thoughts on this from tailwind to headwind down in Washington?
It could be a headwind, and it could prevent yields from rising as much as we and other strategists expected initially. When you look back to earlier this year when we saw long-term Treasury yields rise so much, a lot of that had to do not just with kind of the ongoing reopening of the economy, but all the expected fiscal stimulus. Well, now here we are in October, there's still a lot of questions about, one, what will get passed and the size could be less than initially expected. So if that reduces, the potential Treasury supply and growth, that's one reason why yields might not rise as much as expected. But also, if we look at the debt ceiling debate, they essentially just kicked the can down the road. We're probably going to be dealing with this again in a few months. And if we get to the point where it's another battle to get that raised, that can raise, very short-term T-bill yields when we get to that point, but also pull down long-term Treasury yields. If investors get a little bit nervous about what the ramifications are, you see a flight to quality and you see Treasury yields drop and prices rise.
So far, rates have been up. We closed at 161 on Friday. Of course, the bond market closed today for Columbus Day, but gilt yields are higher, bond yields have been higher through much of this morning. Laurie, let's pick a sector and work through it together. The tech sector. We've got this issue now of higher rates and a prospect of higher taxes too. What's your view on the tech sector right now? You talked about pivoting back to growth in a more material way, maybe in the back end of next year. What's the view right now into year end?
So look, I think with technology, and I want to stress we're talking classic tech here, not the internet names. We're actually overweight there. It's very much a longer term call. We think that you will see, once the Fed rate hikes come into view, we'll see the market shift from value back to growth, which is typically what the playbook is. And outside of expensive valuations, we don't really have a problem with the tech sector, and the earnings revisions have been very, very resilient. I do think when we talk about tax, we do think that issue has been getting baked in. We were sending a lot of screens to clients over the summer looking for tech and healthcare companies that were the biggest beneficiaries of Trump's tax reforms. I think the buy side has really already done the work there. I think, though, when we're thinking about yields moving up, and our rate strategy team says we could go up to 1.75 later this year, and there might be some upside risk to their view. That'll be painful for the tech sector in the short term, no doubt. But we think that this is just sort of a rough patch, and you've got to wait it out. And we don't think it makes sense to really ratchet down the exposure when we're going to be telling people to go back there pretty soon anyway.
Laurie, you mentioned the buy side. Let's talk about institutional investor sentiment right now. You've typically...
Okay, traders, new order placed to sell short euro. This order placed at 115.66. Okay, please copy this trade and this order, sorry, not trade, and wait for position get filled. Okay, and then stay with me, follow my trades, and I will guide you through this trade until the end. So we will collect the profit. I'll let you know I'll tell you when to put stop for your position. We never sell with losses. If you want to get a strategy, you need to go to company.co.uk. Okay, guys? Stay safe.
A lot of the issues, whether we're looking at supply chains, corporate taxes, are things that are well anticipated, and investors, frankly, are viewing them as more of a modest negative as opposed to a major negative. So that's telling us that even those investors that are being a little bit more skittish in the short term are still going to be looking to buy the dip for the longer term.
Laurie, thank you. Laurie Cavacina sticking with us alongside Colin Martin and Jim Bianco. Coming up in the morning calls and later, US banks gearing up for third quarter earnings, on pace for their biggest annual gain in more than 2 decades. This market is up big. The KBW Bank Index advancing 39% year to date. And since September 22nd, you've had a big lift for several banks off the back of a conversation about tighter monetary policy in America. The prospect of higher rates driving this story in the last couple of weeks. That's all coming up from New York City this morning. Good morning as we count you down to the opening bell, 7 minutes away. We're down 8 off session lows and negative 0.2%. This is Bloomberg.
Okay, guys, position opened at 115.66, just right here. Well done. Stay with me, guys. All of you who decided to trade euro right now, and you still have chance. It moved up, so stay with me, and I'll speak to you later. I'll let you know what we're going to do with this position next. Stay safe.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kayleigh Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
In many ways, the week begins on Wednesday when earnings season starts and we get US CPI as well. As we approach the opening bell this Monday morning, equity futures off the lows, positive on the Russell, negative on the Nasdaq by 0.4%, and on the S&P down just 7, we're down 0.2%. As the price action, here are some morning calls. Your first call from Deutsche Bank, upgrading Starbucks to a buy. The analyst highlighting the stock's favourable valuation ahead of this month's earnings. That stock is positive 1.4% to 112.77. Your second call from the team at Credit Suisse, raising its Netflix price target to $7.40, expecting a strong slate of programming to fuel subscriber upside. We advanced there a third of 1%. And finally, Goldman downgrading ConocoPhillips to neutral, seeing limited upside after the stock's recent rally. That stock is positive 0.4% to 75.21. Up next, the big banks kicking off earnings season this Wednesday, looking to keep the momentum going after outperforming throughout 2021. That's just around the corner. Your opening bell, the start of a new trading week, is next. This is Bloomberg.
1972 Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones, really, for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses, because we have a captive audience. We have people home that really want something to do and need entertainment, so we do our best to try to give it to them.
How far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet
We might be.
that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
A brand new trading week starts right about now on the equity market. Futures are negative on the Nasdaq. We're lower there by 0.4%. A little bit softer on the S&P 500, -7. We're down about, what, 0.1% and change, down 0.2. It's Wednesday. The march towards Wednesday. Bank earnings and CPI in America. That's the big focus right now. The opening bell ringing in New York City. Switch up the board and get to the bond market. 10-year Treasury yield shaping up as follows. 119. In the UK gilt market, your Treasury market's closed. It's at 161 at Friday's close. And the gilt market is a lift again by 3 basis points. Call it 4 off the back of a more intensified conversation about raising interest rates. So the FX market, euro dollar unchanged at 115.71, and crude, we keep marching higher. 81.11 through 82 earlier, up 2.2% right now. We're negative at the opening bow by 0.14% on the S&P. Leading the charge, it won't be a surprise. Energy up 0.8%. Financials up about 2. Let's break this down at the market desk and get you some movers. Here's Abby.
John, well, despite that modest slight decline for the S&P 500, let's start out with what is working. And as you just indicated, that is energy, with oil at $81 a barrel, its highest level in 7 years. Right now, the week is, of course, young, but on pace for an 8th up week in a row. If that holds through Friday, that will be the longest weekly winning streak since May of 2015. That's a long way of saying the oil and energy bulls are out. You see it with ExxonMobil up 1%, Occidental Petroleum up 2%. We also have the other part of the reflation reopening trade working. Freeport-McMoRan and U.S. Steel, the metals and miners, higher, with copper going higher and other metals going higher. Now, as you were just mentioning, the bond market here in the U.S. is closed, but maybe it's that gilt action, yields rising over in the U.K. and Europe, that's really helping out the big banks here, because we see some decent increases of more than 0.5% for J.P. Morgan and Bank of America. Interestingly, the other side of that trade is also acting as though yields are higher here in the U.S., but again, maybe it's that U.K. action, because you can see Apple and NVIDIA down as though yields are higher, pressing valuation concerns. And right now, John, we do have a little bit of underperformance for the NASDAQ because of that tech decline, but you have so much strength for energy and banks. Let's see how the day plays out.
Similar story on the S&P, Abby, thank you. Communication names down by around about 0.5–0.6%. Information technology down 0.5%. Utilities underperform, down 0.7%. Top of the pile, energy up by more than 1 full percentage point. Off the back of this, just continued rally in crude. Ed Morse, a City out this morning, talking up $90 a barrel maybe in 4Q. 90 doesn't sound a lot when we were looking at 84 on Brent already earlier in the session. 90 feels quite real at the moment, which explains why we've had this big positive move through energy, another pickup more recently. Earnings season kicks off. It starts with JP Morgan this week on Wednesday. It ends with Goldman Sachs on Friday. This from Wells Fargo's Chris Harvey, weighing in on the financials and saying on the following: positive bank earnings could sustain the upward trend in EPS revisions. They should benefit from Q3's rising yields, busy M&A and IPO calendars, and minimal credit quality issues. That's from Wells Fargo's Chris Harvey. Katie Lyons, what a week we've got coming up.
Yeah, a big week for the big banks, John. And the question really is whether this report or the reports we're about to get can justify and support the rally we have already seen. This is what Chris Harvey was alluding to. The S&P 500 bank index is up more than 40% or nearly 40% year to date, as is the KBW bank index. And actually, it is heading for its best year since 1997, outperforming the broader S&P 500 by a margin of more than 20 percentage points. That is the widest degree of outperformance since the year 2000. And as for the individual names, it's Wells Fargo that has actually been the leader, up 59% over the course of 2021. Goldman, Bank of America, Morgan Stanley all posting gains north of 40% as well. Citi is the laggard here, only up 17%, but again, that is in line with the gains we have seen in the broader market. Of course, you have the macro environment working in banks' favor here, John. You have the broader economic recovery, but you also have higher yields and a steeper curve. The question is, has the rally banks have seen as a result of that make them priced to perfection and therefore vulnerable to downside if we get any kind of earnings disappointment? The jury is still out on that. We'll have more clarity on that this week. And as for what to watch for in those earnings, loan growth, net interest income, investment banking activity, really important, especially when it comes to trading. As we just saw there, trading revenue in 2020, $177 billion for the big banks, but that was when volatility was a lot more abundant. That has come down, so we are expecting trading revenue to decline. JP Morgan, which of course kicks us off, expecting it to be 10% in the quarter, John.
Kelly, thank you. Thank you very much. Still with us, Jim Bianco, Laurie Cavacina, Colin Martin. Laurie, you like this sector. You like it a lot. Chris Harvey from Wells Fargo, a long list of reasons to like this sector. Rising yields, busy M&A and IPO calendars, minimal credit quality issues. Laurie, why do you like it so much?
So look, I would say we always start with valuation. This sector has been very, very cheap relative to the broader S&P. And if you look at that relative PE over time, we've been well below the long-term average. So there's still just a lot of valuation room if the fundamentals cooperate. Now, when we think about those fundamentals, we really like the higher yield environment right now because you do tend to see upward revisions in the financial sector when 10-year Treasury yields are rising. So we think that's another point in favor. I would just also add that we're worried about that supply chain risk spreading out of the industrial materials complex into other sectors, but this really just does not seem like a major issue for the financial sector. So we think we're sort of out of that hair in the near term. And then I would just add, John, we've all been talking about rising rates and sort of the move there and the impact, but the underlying conditions for the value trade, which the financials is a major part of, financials don't work if value is not working and vice versa. It all goes back to COVID. And what we've seen all year is that the value growth trade is trading on the trend in global COVID cases and U.S. COVID cases, and they are coming down. And that has helped stabilize and reinvigorate that value trade. And with supply chain pressure sitting in industrials and materials, it pushes even more investors into this financial space right now.
Laurie, I hear a lot on the banks, and one of the reasons I hear continuously, you do too, we all do, higher rates. I want to understand from your perspective, if banks do well on higher rates, regardless of what is driving higher rates, what's the story there?
Well, look, I think you do at the end of the day need a strong underlying economy. And we really go back to what we've been seeing in earnings call transcripts these past few months and even, frankly, the past few weeks, which is the supply chain issues are there. This has caused some reverberations in sort of quote unquote demand or revenue numbers. But at the end of the day, the companies, whether it's corporates or consumers that are being discussed, the appetite is all still very, very strong. And I think that's important because we really, when we look at that and when we look at trends in high frequency economic indicators, we do not see signs that a recession is at hand. And I think as long as that is the case, and as long as that sort of appetite is still there, I think the financials can do well. You need the rates going up for the right reasons.
Banks are flying. Let's talk about it, Jim. Are rates going up for the right reasons?
That's to be determined, I think. You're right, though, that rates go up for one of two reasons. Everybody likes to think it's because of growth, but if it is because of inflation, it might not be the right reason for it to go up, and the banks might have some trouble. And John, let's be honest here about the banks. They have been the worst. The financial sector has been the worst performer of all the 11 S&P 500 sectors for the last 23 years, for the last 10 years, and for the last 5 years. A lot of careers on Wall Street have ended because people have fallen in love with banks. I agree with Lori. They're good for a rental right now that they're probably going to go higher. But the long-term prospects of the banking system has been very terrible. And that's why you've seen such horrible underperformance by them for decades and why they've got such good valuations, because they can never really deliver on the hope. And now we've got disruption coming for the banking system, whether it's in the form of fintech or cryptocurrencies. And I think investors have been wary of this sector for decades, and they've been right to. And I think after this rental that banks go higher and financials do well, I think those worries will return.
If I was to walk away now, Laurie, and say, Laurie says rent them, don't own them, would that be a fair characterization of your stance?
Look, I think, we'll see where we are, in the middle of next year. We want to see that the valuations are still there, but we do expect the market to transition from value back to growth late next year. And so that would indicate, some caution returning to the financials. But I'll tell you, the one reason why I wouldn't want to make that call right now, John, is that, we talked a lot about institutional investors who are in love with growth. Let's talk about retail investors who are in love with income and dividends. And when we look at one of the biggest justifications for the retail investors supporting the U.S. equity market is that dividend income appeal, you get a whole heck of a lot of that in the financials and the banks, and we think that's going to be around for some time to come. So I understand what Jim is saying about the disruption, but I don't think that's the only thing that an important category of investors that frankly has done a lot to prop this market up recently is looking at.
Colin Martin, I want to bring you into this bond market conversation, the rates conversation. There's two phases to the sell-off in treasuries this year. There was Q1, then there was the move off the back of the lows in early August from about 112.58 through to where we are now at 161 at the close on Friday. The move from 90 basis points to 177 had this corresponding lift in accelerating growth expectations. Phase one of this sell-off this year, Colin, for me at least, was very different to what we've seen more recently. What underpinned the move in Q1, and what underpins the move more recently from August and those lows to where we are at the moment?
Well, the move in Q1 was likely due to a lot of the fiscal stimulus and just reopening trade. Yields were so low, it was expected that we were going to get a lot of stimulus, a lot of spending as the economy recovered. What we're seeing now, I think, is mostly driven by inflation. It's not just actual inflation indicator readings that are rising, but we're starting to see inflation expectations rise, and that might continue given the rising trend in oil prices. If you look at the TIPS market, for example, break-even rates had come off their first quarter highs and had been trading in this pretty tight range for about 3 months. They've recently broke out of that range, and that could lead to higher yields down the road a little bit as we continue to see these elevated inflation readings, which are likely to be less transitory than initially anticipated.
I just wonder how much power is in a word, Laurie, and to come back to you on this, we keep throwing around this word, reflation, every time we see high yields and energy up on the same day. Reflation to me is better growth driving prices, not higher prices potentially weighing on growth. And the reason I bring this up, because I wonder if some people will get trapped in the old playbook, the reflation playbook, and get caught out a little bit. Laurie, how are you thinking about that at the moment? Just the power of that word, the reflation trade, so to speak. What does it mean to you?
Well, look, to me, reflation was more about coming out of the crisis, coming out of the pandemic and reinflating everything, whether it was the economy, whether it was inflation itself. I'm actually not using that word quite as often anymore, John. We've really sort of, migrated back towards value and cyclicals because we think that's really what it's all about right now. We do understand that things are decelerating. Some growth expectations may need to soften, but we're really trying to stay focused not just on the trend, but on the level. And the level is telling us, in terms of looking at all the forecasts around the street, that we'll be able to stay above average for quite some time. And just putting financials aside for a second and looking at the broader market, we do tend to see that areas like cyclicals, like value, like small caps, for example, can handle deceleration in the economy as long as we're still above that, in above average environment. So I think that's an important nuance. Deceleration to below trend is an entirely different thing than decelerating to a level that's comfortably above trend. So it can let those cyclicals live a little bit longer.
It's a really good point, a really, really good point. Jim Bianco, can I get a final word from you on that, sir, just on that topic of reflation?
Yeah, I think it's important to separate the two issues there, is whether or not it's being driven by growth or it's being driven by higher prices. And coming out of the August low, I do fear that the market is more worried about higher prices and that is just a reduction of purchasing power. That is a reduction of demand, of growth, because we're just going to have to just pay more for the same thing that we used to get just a few months ago.
Jim Bianco, Laurie Calvasina, Colin Martin. Guys, been great to work through this market with you. Around about 12 minutes into the session, stateside, the S&P 500 positive 0.04%. We talked about what's top of the pile. It's energy again, up 0.8%, with the crude rally continuing this morning. We had a look through 82 on WTI, right now $81.04. We had a little look through 84 on Brent. Right now Brent 83 and 89, call it 83.90 on Brent at 1.8%. Coming up, we head back down to D.C., division remaining. Democrats still fighting with Democrats. Republicans issuing another warning to President Biden. That conversation up next from New York. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Wrong with her eye. When I had a look, it looked like she was blind. The vet that she's registered with were only doing telephone appointments, which was a bit pointless because she really needed to be seen by someone, and I couldn't get one anyway for like another week. I was just quite worried about, you know, the complications of leaving it for so long.
We've seen millions more animals becoming pets in the past year due to the people having increased time at home. What we're also finding is due to Brexit that we're having decreased numbers of European vets working over here. So unfortunately, we're unable to meet that current demand for pet services. Also, COVID's got the inevitable impact with people having to self-isolate.
It is very limited what we can diagnose, so it's more about peace of mind and determining whether they do need to be seen in person.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The work of our time is to prepare ourselves for it to be competitive to win the fast-changing 21st century global economy. That's why I propose two critical pieces of legislation being debated here in Washington right now. These bills are not about left versus right, or modern versus progressive, or anything else that pits Americans against one another. These bills are about competitiveness versus complacency.
President Biden promoting his agenda with Democrats divided. On the debt ceiling, lawmakers kicking the can to December, as Minority Leader Mitch McConnell issues another warning, writing in a letter to President Biden the following: "I will not be a party to any future effort to mitigate the consequences of Democratic mismanagement. Your lieutenants on Capitol Hill now have the time they claimed they lacked. They cannot invent another crisis and ask for my help." Down in D.C. is Bloomberg's Joe Matthew. Joe, I start with this one. I start here every morning with Washington. What is going on?
Very little different today than was the end of last week, Jonathan. Just look at the talking points over the weekend. I'll remind you, the House has yet to even pass that stopgap solution to extending the debt ceiling that seemed to save the world at the end of last week. Lawmakers will handle that tomorrow. And you've got administration officials and lawmakers out over the weekend using the exact same talking points, whether it was Janet Yellen or members of the Progressive Caucus on Sunday morning television, all ringing the bell here on a potential default, on a potential catastrophe as they try to enact the Biden economic agenda. But I would also remind you what's going on today here. This holiday brings lawmakers home, right? And they're going to be taking part in holiday parades, maybe talking to constituents out there, and they're going to get an earful one way or the other. The question is, will that cause them to want to negotiate with each other a little bit more? And by the way, I'm talking about Democrats with Democrats. Or will they dig in their heels more on their positions? These are the voters who sent them to Washington to get something done, or in some cases, when it comes to moderates, to prevent something from getting done. And it could be a tough debate when they all get back to Washington this week.
Joe, we're told time and time again that there might be division in D.C., but the country is united behind some of these proposals from this president. Yeah. Apparently they're very popular. So why is the president so unpopular at the moment?
Well, it's an interesting question, and a lot of it may have to do with efficacy. You know, when you keep swinging at the ball here, Jonathan, and you're not knocking out home runs, it does start to create an aura of weakness. We're also hearing really tough language from actual Democrats, moderates, who do not want to see a $3.5 trillion plan go through Congress, and it doesn't look like we're going to get one here. But look, you know, voters like to vote for winners here. If Joe Biden gets one of these or two of these done, you might see a little bit of a change in those polling numbers.
Joe, what's the conversation sound like around inflation? We get CPI data here on Wall Street on Wednesday. It's going to be a big focus for us, no doubt. Is that becoming a bigger focus down in Washington, with crude back at $81, $82 a barrel?
It absolutely is. The Biden administration has actually been talking about this massive spending plan as a way to combat inflation. But if you ask Joe Manchin, who's deeply concerned about rising prices, he'll tell you it's going to make things worse. You know how things go here. You can turn the graph upside down and look at it sideways in Washington and use inflation as a way to argue your case. Joe Manchin, though, has really put his foot down on this, saying that he does not believe what the CBO is saying when it comes to scoring infrastructure, or what it may say when it comes to scoring reconciliation. He believes this will cost billions, if not trillions more than we're already talking about when it comes to an expansion of Medicare, when it comes to child care and so forth. And he looks at his constituents in West Virginia who are already paying more, not just for gas, but for food and a lot of other issues, to say, hey, listen, they can only take so much, and another spending bill could make that worse. Republicans use similar arguments, but Joe Biden says, and you hear it from Jen Psaki in these press briefings every day, that prices will continue to rise until we manage to get this spending deal through and create more economic growth. Jonathan, I'd turn back to you on that one. You're the expert on the markets here. Washington's never going to agree on that.
I wish, Joe. It takes a long time to build out capacity. You know that. You know that. Joe, thank you, sir. Looking forward to sound on Bloomberg Radio. Joe Matthew there, down in Washington, our Washington correspondent. The lead in Politico Playbook this morning just dropped about 20 minutes ago. Biden blows it. President Biden blows it. Pressure building on the current president down in D.C. at the moment. Let's get you some sector price action. The pressure building for some equity bulls out there as well, Abby. This equity market choppy over the last couple of weeks.
It certainly has been choppy, but right now the bulls are leading despite the pre-market losses. We now have the S&P 500 up about 0.25%. And you can see sector-wise, it actually looks more bullish than the modest gain. Leading are the cyclical and value sectors, to make Lori Calvasino of RBC's point that it's not reflation, considering that was really out of the pandemic lows. Now it is all about the cyclical and the value sectors, materials, energy, financials, even with banks, or excuse me, the bond market closed, so yields not flying. It seems that banks here are getting a little bit of a bid ahead of earnings season and also off of the European yield action. You can see in turn utilities to the downside, down pretty sharply. That's a defensive sector though, so even though it's down because despite the fact that the bond market here is closed, but you have European yields higher, that is a sign toward the risk on move. So maybe the small gain for the S&P 500 will build. But the real story here, John, today is, of course, energy and oil. If we take a look at energy on the year, up 50%, on pace for its best year ever, right aligned with oil. But the amazing thing is, John, oil on the year up 67%, its best year since 2009, making the case, if we were to chart the two together, that maybe there's even a catch-up trade for energy, even with it being the best sector in the year, up 51%. Pretty interesting stuff.
What a rally here today, Abby. Thank you so much. Looking ahead to the week ahead, I'll run you through the trading diary in just a moment. On Wednesday, earnings season starts. We also get CPI on Wednesday in America. Then on Friday, we get retail sales. This just dropped from Steve Englander over at Standard Chartered. Markets are keying off stagflation fears, not growth, and this week is likely to feed those fears. We think, they think, CPI risk is to the upside and retail sales growth to the downside. The dollar is the likely near-term winner from those outcomes, with both rates and the risk environment supportive. The latest from Steve Englander there of Standard Chartered. From New York City, your trading diary's next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
Around about 25 minutes into the session, a morning of mild losses turns into a morning of mild gains, seemingly. On the S&P, up 1/3 on the small caps, the Russell, up 0.4 on the Nasdaq. We advance about 1/3 as well. That's the equity market. Here's the trading diary. A ton of Fed speak this week, starting with Chicago Fed President Charles Evans at 6 p.m. Eastern. Later in the week, it's Vice Chair Clarida. Then on to Bostic, to Brainerd, to Bullard and Barkin, all on deck. If you don't get bored of that, you get the Fed minutes coming up on Wednesday. The data, important this week as well. CPI numbers on Wednesday, then the major banks kicking off third quarter earnings as well with JP Morgan. Finally, once you get through all the banks, we round out the week with retail sales on Friday. So you've got the bank earnings and two pieces of important economic data, CPI Wednesday, retail sales Friday. And if you want to steer on the Fed speak, it's over to Vice Chair Clarida tomorrow. Looking forward to that. Thank you for choosing Bloomberg TV. For our audience worldwide, this was the countdown to the open. This is Bloomberg.
impact China's growth because it is already slowing. Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, part delays, chip shortages, saddled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
From New York City.
We're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics? Google is saying it has accelerated innovation in the country and it's planning to appeal the FTC's decision. What's your take on this and how do you plan for further scrutinies?
We are going to see what they make and what changes they are actually bring to this market.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off. These guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease beside disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.